buzzing right and you said I want to go lower. I'm not sure if you're using outside. Alright,
Oh,
Ooh.
Of a gap to the downside that we could actually test around this 10.75 level, or $10.75 if you're a grain trader here, where we could actually see a pullback to the downside, and then even looking at that $10.45 area as a major area of support. So lackluster commentary coming from the USDA on these purchases. Once again, confusion when it comes to the White House, but China is making steps. It's not like they're not purchasing, but the end of the growing season for soybeans, and the big thing is that's in November, so it's already passed, so it doesn't really lie to the White House team.
Yeah, it's interesting, isn't it? Certainly a little bit of confusion in the market this morning, shifting goalposts. It's interesting, you know, obviously the US are managing to sort of extend this timeline as well for China to make these purchases as well. I mean, you've had the news around the H200 chips this week too. You just wonder how much China is doing, you know, as part of the concessions and as part of the trade deal as well. I mean, I know they're holding off on some of the rare earth export controls, but, you know, certainly an interesting dynamic as far as this trade tension is concerned. Let's just stick with the commodities theme. Look, silver continues to catch a bid. I mean, we're extending gains today. Gold is under a little bit of pressure today, but yeah, talk us through spot silver right now. I mean, we hit an all-time high earlier, but, you know, obviously we managed to hold on to some of these gains right now. What's driving that?
Yeah, well, you still have the fundamental backdrop of silver. It's in a structural deficit. It has been in a structural deficit for at least the last 5 years or so, especially when you start adding in the ETF holdings and ETFs like SLV and things of that nature. And so buyers continue to step in. I think this is more of a risk-on tone in the market, but it also signifies that the market might be pricing in higher inflation and higher yields moving forward as well. That's usually what you see in a correlation between gold, silver, and yields. And so this is not really a speculative trade, and I saw a post about this the other day. It's not really a speculative trade that the Fed's going to cut rates. It's really focusing on economic growth and expansion, because silver is an industrial metal before a precious metal, and it has been moving to the upside. Also, retail buyers stepping into SLV. SLV is actually covering their positions with physical silver bullion. So if the physical market is still seeing a short coverage type of an event, that could push prices higher. Today's candle, keep your eye out on it though. I mean, right now it's looking like a shooting star candle. We are seeing RSI making a lower high, so we are starting to see a bearish divergence in some of the momentum indicators, but it's hard to fade this particular trade right now. But if you're new to silver, and I always have to put this out there, if you're new to silver, be careful, because it's a very volatile metal, a lot more volatile than gold, and so this thing can move aggressively higher fairly quickly, as well as re-rate lower fairly quickly.
Okay, and just shifting to Dr. Copper, I mean, you've got this obviously managing to catch a bid as well. We have also seen these nice highs as well as far as prices are concerned. I've seen that Morgan Stanley is expecting this to continue as far as the price forecast into 2026. You've got obviously the demand story. Just talk us through sort of the price action right now for copper.
Yeah, you are seeing it trying to make new highs. The next area of resistance around $5.80. So this is another situation where there will be a supply deficit and some issues when it comes to mining copper ore in 2026. That's pretty much known now after we've seen a lot of the earnings announcements over the last month and a half from these copper miners. And so you are seeing some buyers really stepping in. Maybe also some optimism when it comes to China. They had some inflationary data yesterday. If you look at the CPI, it still came in lower than the street's expectations. But if you're looking at the year-over-year print, it's getting closer and closer to where a lot of economists really want to see China moving to the upside when it comes to inflation, and that could also be a tailwind when it comes to copper. And then we have the AI story taking place as well. So this continues to move higher. Also, just kind of note, the London Metals Exchange, or the LME, is really what's being quoted on an international basis when it comes to copper. So every day you're probably hearing that copper's trading at all-time highs. That's in the London Metals Exchange, not here at the COMEX. And what you probably will see if copper is going to top is a shorting of the London Metals Exchange copper and the buying of COMEX and lowering that spread here. So maybe another move to the upside here for copper in the next couple of weeks.
Okay, moving to the upside to the tune of 0.7% right now for copper. Silver just dipped, but we are keeping an eye certainly across the commodity space. Thanks so much for that, KG. We'll check in with you a little bit later. Coming up, we will dive into what's at stake for the Fed with Ben Emmons from Fed Watch Advisors. Morning Trade Line is back after this.
messenger.
I'm Nicole Pedalides at the New York Stock Exchange. Live interviews, market movers, and real-time coverage right from the floor. Subscribe now at schwabnetwork.com.
What's up, Carl Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I've seen something from Schwab.
Uh-oh. Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties.
Carl.
Schwab, a modern approach to wealth management.
No politics, no spin, just the market from open to close and beyond. Streaming 24/7, any screen, anywhere at schwabnetwork.com.
That's what it looks like, because the market's trading it this way. This morning when the yields are higher and goes down and stocks are waffling and sort of mixed. So I think it's right, Sam. It's a hawkish cut, and that means that they're going to cut rates today, but they're going to likely signal that they're going to stay on hold for a period of time, something of that nature. And then it kind of depends how that message is delivered, because if it's delivered like in October, which sounded quite hawkish and unexpected, then you could see some volatility. If Powell sticks to the script, I guess it's a meeting that's going to play out relatively okay, but it is a meeting where it's sort of saying, got to get to the end of this easing cycle at this point to kind of sit back and wait what happens.
We certainly have to sit back and wait to see what happens because, I mean, the higher yields have been a bit of a head scratcher, haven't they? Because, I mean, the setup looks somewhat different to, previous FOMC meetings as far as, the bond sell-off that we've seen. I mean, you don't fight the Fed. I mean, that's the sort of mantra, isn't it? But let's see what happens. What are you looking out for as far as the dot plot is concerned? I mean, there's been conversations around how we could see 3%. I've heard this morning there could be 5. I suppose it's not just, 2%, but where their dot is.
I think that's the important part of this, and where the executives dot plot land, because that's how they would express that instead of more in a quantitative way. Because, you could guess who would be dissenting. I guess Mylan would be the one for 50 basis points, and then Schmidt would be for keeping rates on hold. But who would be signing, and Schmidt is the most important part of it, because that will determine that dot plot shape, and it comes out at the same time, right? So we get the message from the Fed both ways. I guess is that if we have a projection in September of 2 cuts for next year, that's where the question will be, will that be one cut? And that's what the 10-year yield seems to be implying currently, that it moved up about 25 basis points from the recent low, maybe indicating that it will be 1 cut year instead of 2 cut year. And anything that happens further out is a little bit too ambiguous, but people can see the path that the Fed will be also coming to an end of this easing cycle as the ECB already is at its end. And it seems like in Australia they may be moving back towards a hike again. But that's sort of the scenario that's going to play out. And this Fed maybe be in a dot plot where it says, look, inflation is going to stay above the target and unemployment rate is kind of where it is. You can't really project more cuts out than maybe one for 2026.
Yeah, I mean, it's certainly an interesting story when you look across what's happening globally with these other central banks. I mean, the ECB looks like it's pretty much done here. I mean, you've got talk, as you just mentioned, of Australia, I mean, pricing in a potential more hawkish RBA there. Obviously, the BOJ expected to hike next week. You made an interesting point in one of your notes yesterday, and I quoted you in the show that you're seeing an overall improvement in labour conditions. I mean, obviously we got the jobs out yesterday. It doesn't look like anything sort of disastrous. I mean, if anything, it looks like things are pretty stable as far as the deterioration we've seen in the labour market. But you say this makes the case for risk management cuts less compelling, and that's a good sign because it suggests past rate cuts are helping stabilise employment. Do you think we're starting to see that transmission already?
I think so, Sam, and I'm glad you bring it up because I think that's exactly what's playing out. Like these jobless claims staying so low in the wake of a major government shutdown, which would have affected jobless claims at least seasonally. So that's interesting to note. And then you mentioned the job opening seems to be stable now, if not robust. And most of all, the unemployment rate, although it has come up, there's also people coming back into the labor force. That was what the last payroll report showed. That's a positive sign that people come back into the labor force because they think they can find work quicker again. And then lastly, it's some of the indicators that the Chicago Fed, San Francisco Fed put out. There seems to be less stress in this labor market overall. So having improving conditions, I think really because the risk management once again worked like they did last year. They cut rates to try and get ahead of a problem in the labor market. And it seems to be working. So I think this is why this will be the last cut. If they do it today, they don't need any more risk management. They can kind of keep unemployment rate here where it is because they did enough to help the economy.
And how much, should we be paying attention to, who Trump is thinking about, sort of replacing now? Because there's been a lot of sort of market reaction, particularly when you look at the bond market, to Kevin Hassett potentially being the front runner here with that steepening of the yield curve. A couple of other names being thrown around here, but how significant is this? What are you watching into 2026?
I think it's very significant because this Fed chair is obviously someone who has the eyes of the president so strongly. I mean, basically it said the other day that it's a litmus test, right? And the first meeting, June of next year, will be a meeting where this Fed chair is expected to lower rates. And that may be your one cut that will happen next year. Who knows, right? It's a little far out, but I do think it's significant. It sets the tone in the Fed, but at the end of the day, everybody agrees it's a committee, it's a consensus, it's a body, that will not change too much. And the Supreme Court now, with this FTC firing that seems to be happening, did say that they have a carve out for the Fed, meaning that there will not be, the Supreme Court will not allow the Fed to be anyone there to be fired. So I think that risk is off the table, meaning that if the new Fed chair comes in, you cannot just sway everybody into this rate cut, the threat of being fired if you don't, right? So I think the market is right to sense that this is not going to lead to an accelerated rate cut cycle, this new chair, unless it somewhere puts a different stamp on the Fed than before. I mean, historically, there's no doubt wrong. Powell has been the chair has pivoted the most in his communications from any Fed chair in the last 20, 30 years. And he had significant volatility at times because of the way he communicated. So I think that's important too. There's no chair how he communicates with her relationship, his relationship with the president. Matters what I think to the markets. Because like today, if Powell comes out and hawkish again, it's going to cause volatility, right? So it's about how the message too. I think that matters too. So I think that's what I look forward with the Fed chair in the future.
Right, communication is key. I appreciate your time. Thank you so much for joining
Huh?
us.
Alright, I gotta come outside and get that wood. Thank y'all.
I'm Diane King Hall on the floor of the New York Stock Exchange. When markets react
SchwabNetwork.com.
How's it going? First day, so... Sometimes, you know... Next. Try again? You could have done better. Please. Same goes for where you invest. Level up and invest smarter with Schwab.
Whether you're a bull or a bear, you'll want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
Trading at Schwab is powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
The final 90 minutes of the trading day, that's when markets make headlines and traders make decisions. From earnings shocks to sector rotations, we're tracking the catalysts that move markets right into the close. Here on the floor, I bring you real-time sentiment from traders driving the action. And in Chicago, we break down the data, technicals, and trades you need to see.
My bad, that was maintenance.
Live coverage of the close every single day. This is Market on Close, live weekdays 3 p.m. Eastern, only on Schwab Network.
Let's see how much they got to bounce right here.
Back on Morning Trade Live, Cracker Barrel is trading higher this morning despite an earnings miss and a guidance cut. Same-store sales were down 4.7%. Restaurants are down 8.5% in retail stores in the quarter. The company facing backlash, remember, from customers in August in response to a rebranding campaign.
Oh, they trying right here.
New logos, so getting rid of the old-timer, remember. The shares are up right now 2.5% off the back of that. Welcome back to Morning Trade Live. It's time now for the big picture. Let's welcome in Pat Jones, Chief Fixed Income Strategist at Schwab Center for Natural Research. And very good morning to you, Pat.
It's going to be hard to lift up. We need Jerome Powell to lift the market today.
Why has the 10-year been up around 420?
It's going a little bit,
what you're
though.
seeing is the market isn't buying the need for rate cuts. There are a number of things that go into the 10-year. There's, a big term premium, that risk premium people demand to hold longer-term bonds, and I think that's fueled by concerns that the Fed is cutting when inflation is still too high, concerns about fiscal deficits rising, concerns about global yields rising, led by Japan, and the bond market's just saying, this rate cut talk is probably counterproductive.
Okay, yes, obviously we've seen rising global yields, the highest last seen since 2009, so we're at 16-year highs right now. I mean, I was just having a great chat with Ben Emmons from FedWatch Advisors, talking about how, other central banks, where they're up to in their rate easing or even hiking cycles. I mean, the BOJ for one, we've got some pricing in of a more hawkish Australian Reserve Bank as well. So it's been an interesting one. I mean, how much of this is what we're seeing domestically versus what we're seeing internationally?
Well, when we look at 10-year yields or beyond, I think there's a combination of the domestic situation and the feeling that the Fed is moving towards too easy a policy with inflation still stuck near 3%. But there's also a big global component. When you think about U.S. Treasuries, about half of all Treasuries are held outside the United States. So definitely the yields in other markets are important along with the dollar. And I think what we're seeing is we've had a soft dollar over the past year with rising yields in Japan and increasingly in other markets, steeper yield curves. And that all tells me that the bond market's not buying the need for easier monetary policy right now.
So if the market is pricing in a hawkish cut, because it looks like it's pretty much a done deal as far as 25 pips today, but if Powell comes out and sounds a little bit more sort of bearish,
I gotta go get my rug outside. I had my rug hanging up, and it's raining, and my rug fell. I gotta pick my rug up.
Yeah, we've been in the camp that's looked for a steeper curve for a long time. I think 10-year yields are sort of range bound here. we're testing the upper end 4.25 or so on 10-year treasuries. The yield curve at the short end is pricing in a couple more cuts, which I think is probably reasonable given some of the softness in the labor market. So, market reaction is going to be
Mark
interesting
cannot get
in the
back right
short
here.
run.
This is crazy.
We've already poised for a steeper yield curve, but
Mark
in the
finna
long
go
run,
down
I
some
think
more.
that's the direction of travel. So you might see a little bit of a correction once the Fed comes out, especially if Powell is a little bit hawkish. But I think the longer term trends are in place.
And what are you talking to clients about right now as to where some of the opportunities are at the moment? I was having an interesting conversation with Allspring yesterday. They're talking about how there is opportunity in global government bonds. Where are you looking at right now?
Yeah, so because we expect a weaker dollar, then international bonds globally can make sense for diversification, although the trend is not necessarily your friend there in all markets. But in terms of other positioning, we still like an up in credit quality bias in portfolios. We still think intermediate term duration is the place to be because you balance out the reinvestment risk on one end and the risk that inflation
I think they're gonna
and
start pulling this
deficits
stuff back
drive
now.
up yields at the long end. So we still feel like that intermediate term, high quality portfolio is the
Section right
place
here.
to be. Other opportunities depending on the investor. The municipal bond market offers pretty attractive tax equivalent yields for people in higher tax brackets, even if not in higher tax brackets these days. And that can be a place to look because of the high credit quality in that market. You could go a little longer in duration. And then TIPS, Treasury Inflation Protected Securities, makes sense if your concern is about inflation, you're locking in real yields on the positive side.
Kathy, really appreciate your insights today. Thank you so much for joining us. Appreciate it. Kathy Jones there, fixed income strategist, Schwab Center for Financial Research. Coming up, it's time for the morning trade, and we'll get a closer look at GE Vernova. The stock is rallying today after issuing guidance. Trade Live, we'll be right back.
Trading at Schwab is powered by Ameritrade, giving traders even more ways to sharpen their skills with tailored education. Get an expanding library filled with new online videos, webcasts, articles, courses, and more. All crafted just for traders. And with guided learning paths, stacked with content curated to fit your unique goals, you can spend less time searching and more time learning. Trade brilliantly with Schwab.
Schwab Network delivers real-time market insights, live from the NYSE, NASDAQ, the SIBO,
They can
and
break
beyond.
this and get to
From
here
earnings to
and break.
economic data, we
Probably
cover
looking
what
better,
matters
but right
as it
now,
happens. Streaming 24/7,
it's a lot of consolidation
anytime,
before
anywhere,
the power
free
come
on
out.
SchwabNetwork.com.
Whether you're an experienced investor or just getting started,
A lot of consolidation into Powell.
right for you.
Like this consolidation can last for hours.
Our investing webcast series breaks down different investing styles, including growth, value, income,
They could just ping pong back and forth right here forever until Powell comes out and either go lower or higher. Like we just gotta see how things are about to happen.
And start learning today.
From the most iconic trading floor in the world, this is Opening Bell with Nicole Petalides, live on the floor of the New York Stock Exchange. The countdown, the setups, the stories that make markets move. Minute-by-minute breakdown of the biggest headlines, earnings, and global movers. Just the trades that matter. As the bell hits and the markets react in real time, Opening Bell, live at the NYSE, right when it counts.
We're back on Morning Trade Live. Let's focus on GE Vernova, our top stock on the S&P 500. The stock hitting an all-time high today after the company released multiple guidance updates and hiked its dividend. Here's a chart of the three GE companies over the last year. GE Vernova and GE Aerospace are the clear outperformers. GE Healthcare, though, the laggard in the group, just above the flat line. Okay, that's the focus of the morning trade. So joining us for a closer look now, as always, is the Schwab Network host, Marley Caden. Very good morning to you, Marley. So a lot to chew on from GEV in the latest guidance update. Obviously, higher dividend, higher buybacks, more positive on the outlook here. We broke this story obviously in our show yesterday, but now we're seeing the market reaction and they like what they hear. Talk us through what they've been saying, and obviously we're seeing a nice response as well.
Yeah, absolutely. Good morning to you, Sam. A very nice response for GE Vernova. Up more than 11% right now after, like you said, they doubled their dividend. They increased the scope for share buybacks. They also raised their earnings projections at an investor day that they had in New York. So let's walk through some of the numbers and then we'll get to the street reaction. They're saying their future earnings beyond 2028. They raised those to $52 billion. That's up from 45. They raised their adjusted EBITDA margins for that same period up to 20% from 14%. That is the most mentioned part in all of the sell-side analyst notes. They are also raising their per-share quarterly dividend to 50 cents. They increased their share repurchase authorization to $10 billion, up from $6 billion. They also said they expect to grow their backlog from $135 billion to about $200 billion by the end of 2028, which will include a doubling of its electrification segment backlog to $60 billion, up from $30 billion. They also said they forecast stronger than expected profit margins in their power and electrification businesses, saying that those should generate adjusted EBITDA margins of 22% each by 2028. So let's walk through some of this response and why we're seeing such a positive reaction in terms of shares. Price target raised at BMO to $7.80 from $7.10, right now trading at $6.97, and again, that's up more than 11% right now. And they also felt at BMO Capital that the guidance they gave, they called it, quote, clearly conservative. So they think it could actually be even better than what they're saying, even though everyone's really pleased by it. RBC Capital upgrades to outperform on this stronger outlook. Important to note here, they have a price target of $761. That's up from $630, but the firm had downgraded GE Vernova. So they went out in their note and said, our prior downgrade underappreciated the growth and margin opportunity that is showing no signs of slowing, driving margin expansion from the benefit of expanding equipment margins and productivity improvements. So they basically issued a mea culpa on this one. We also saw JP Morgan raise their price target to $1,000. That's up from $740. They have an overweight rating already. They cited those 2028 financial targets as the reason. They see multiple paths to upside here. We also got a note from Oppenheimer. They upgraded to outperform from perform. They have an $855 price target. They said that they guided significant upside relative to their previous guidance. Same note, everyone's citing these 2028 numbers that they're putting out here. They also mentioned that GE Vernova's expertise in high and medium voltage technologies, as well as integrated solutions, bodes well for their market share gains and their pricing power improvements, of course, as this data center boom continues. And they're not alone. We've got more. B of A. They raised their target to 804, up from 725. That's one of the lower ones here. They do have a buy rating, also mentioning this 2028 guidance as their reason. They say that they think that they have a further 20% capacity increase for gas power equipment, and they think they could grow their backlogs more than they estimated. As another note there, UBS also saying they're very bullish on the new targets. A lot of positive bullish commentary, Sam.
Yeah, as one can imagine, off the back of an 11% pop, and certainly some bullish comments there from the company. Thank you so much for breaking that down. And the reaction we're seeing here today, Marley, I'll chat with you a little bit later on. Let's trade it now with Scott Bauer, who's CEO of Profit Trading Academy. How are you approaching your example trade for GEV today, Scott?
Good morning, Sam. And yes, I sent this trade to you guys about 25 minutes ago when the stock was about $20 to $25 higher. I still have the same bias, but the numbers here may not work out so much. And like you and Marley just talked about, tremendous move, double dividend, talking about power, raising guidance, all incredibly positive. Too much euphoria, too much emotion set in on this move here. So what I'm doing, and what I tried to do about a half an hour ago, was selling call spread, okay? I may add to that at some point, but I'm selling to December 26th, so going out 2 weeks, 750, 760 call spread, looking to collect $4. It was trading there about 30 minutes ago. So if it rallies back up, look to sell it there. Maybe I'll adjust my strikes a little bit here, but I think there's way too much euphoria built into this move on the upside right now.
Oh, interesting. Okay, we're in the 69.4 and change right now. I see up about 11% off the back of this. Just pointing it out, getting your thoughts on the overall market performance today as well, Scott. Just given, of course, we've got pretty sort of range bound, kind of directionless positioning ahead of the FOMC. Interesting moves, obviously, in the bond market. I mean, that's moving. That's sort of telling you what they think we could hear from Powell. But as I said, stocks will be a bit directionless. What do you make of it?
Yeah, I mean, this is playing out like we saw a few months ago on one of the prior cuts, where there was a rate cut and rates went up. So, exactly, the bond market is telling us that maybe we don't need a cut. And it's all going to depend what Powell says. I don't expect him to sound very dovish. I really don't. We'll have to see how the market reacts. Maybe the bond market is moving too far in the other way, selling off a little bit too much ahead of this announcement here. But obviously the market is not expecting rates going down.
Yeah, and obviously we've got the sort of global bond yield higher as well. I mean, Germany's 10-year yield, 9-month high, French 10-year high since March as well. I mean, obviously in Japan as well, Australia. So that's obviously keeping things elevated too as far as the bond sell-off we're seeing. Scotty, thank you so much for that on such a key day, and also Euro example trade for GEV. Scott Ballard, CEO of Copper Trading Academy. Coming up, we'll take a closer look at the sectors on the move this morning and examine the news moving markets over China.
You got $2. If I would have had, would have been amazing, but it's okay. 4K printed. All these bulls for 1 hour they spend, they flip, and the condition was good.
Morning movers, be the first to find out what's shaping early market action. Tech check, options corner, futures focus, technical analysis. Morning movers covers it all. Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network. Stay connected to what moves the market. Download the Schwab Network app and stream anytime wherever you are. Live from Chicago, this is Trading 360. I'm Marley Caden. We track macro forces, market trends, and company news that shape investor decisions, all with expert analysis and actionable context. From inflation data to sector rotations, earnings to policy, it's a comprehensive view of the market every trading day. Trading 360, in-depth market coverage straight from Chicago. Weekdays at 11 a.m. Eastern on Schwab Network.
Welcome back to Morning Trade Live. I'm Sam Barnes, coming to you live from the New York Stock Exchange. So it's time now to take a look at the sectors of the moving markets this morning. So today we're joined by Kevin Higgs to get us across what is happening here. So as I said, it feels like a sense of calm when you look across the major averages today. A little bit directionless, but obviously we're waiting for what Powell and Co have to say. What are you seeing sort of beneath the surface there, Kevin?
Good morning, Sam. I think this market is like a 100-yard dash on the starting line. We're waiting for the bell to go off. We're waiting for the decision to come. And then I think this market will get real busy this afternoon. But starting the day and looking at the sectors, it's interesting. The S&P is down about 1/6%, right? Why is that? Well, 8 of the 11 sectors are higher, Sam. But the two heavyweights, information technology and communication services, are both lower on the day. You know how I know that's important? Because the equal weight S&P is actually up on the day. So, those two heavyweight categories of the S&P are lower. Good news is, consumer discretionary, led by Amazon, being a pick of TD Cowen, that's up on the day. So all things considered, this market is one of those days where eight are up, but two of the ones that are down are the most important sectors of the S&P. But we wait till 2 o'clock Eastern, Sam. All that could change.
Oh, it certainly could, and obviously there's been such a big conversation this morning, whether the markets have got it right as far as what they're pricing in here, as far as the Fed decision, or the bond market's got it right. Interesting that you say, obviously we're seeing technology, communication services lower today, but the others are up, the equal weight actually higher. What other stories sort of stick out to you today? Obviously a big story around GE Vernova, we've just been across that, we continue to track the drama and this, bidding war that's going on between Paramount and Warner Brothers, Netflix. I mean, those two names are also higher, top movers on the S&P 500. What really sticks out to you right now?
I think the Warner Brothers news is going to play out over time, and the one theme there, higher prices, right? When there's bidders, when there's hostile players here, the prices are going to go up, Sam. GE Vernova news, it's amazing, isn't it? It should be one of the stories of the year, how GE, the pieces, have done so well once they broke up the company into the different parts. I think that's one of the great stories of this year, and the job that Larry Culp did. Remember, a lot of people thought GE at one point in their history was insolvent with all the pension and the retirement and all the problems they had. They thought this company was bankrupt, and now the growth is incredible. It's one of the great stories of this year. I think TD Cowen putting Amazon on their best idea list, looking for a 30% upside. That's what's moving consumer discretionary higher. But Sam, the big story, we sit and we wait for the big news at 2 p.m. Eastern.
Yeah, we're also sitting and waiting for Oracle as well. I mean, past the FOMC, that's going to be a big one too. Let's see what they have to say, whether they can sort of reassure the markets around some of these concerns right now that they're tapping the debt markets to fuel what they're doing as far as AI too. So I think, that's going to be an interesting part of the story too. Kevin, thank you so much for your time. Really appreciate it today. Let's widen our scope and take a look at global markets. No shortage of headlines surrounding China and Nvidia this morning. The information out with 2 reports. The latest saying Chinese AI startup DeepSeek is using banned Nvidia chips in the race to build its next model. The report detailing how Nvidia's Blackwell chips are smuggled into China through countries that permitted their sales, then dismantled and shipped them to China after they were cleared by companies making the server equipment. Now, the information earlier reporting that Chinese officials convened meetings with representatives from Alibaba, ByteDance, and Tencent and asked them to assess the demand for the H200 after the US approved the export of the chip to China. Officials reportedly telling the companies that they'd be informed of the decision soon. Now, Reuters separately reporting that Alibaba and ByteDance have asked Nvidia about buying its H200 chip, saying they're keen to place big orders for the chip, should Chinese officials give them the green light to do so. The Chinese tech companies are said to be worried about supply and are seeking clarity from Nvidia. Now, in other news, Chinese deflationary pressures continue to weigh. The good news is that Chinese consumer prices kicked up annually in November, the fastest pace in nearly 2 years. However, on a monthly basis, prices cooled after the October holiday. User prices stayed in deflation, falling 2.2% year on year, dragging wholesale deflation into its 4th year. Coming up, it's time for Inside Out. We'll take a closer look at Adobe ahead of earnings and bring you an example trade for that name when One Trade Live comes back.
Hey, investors, you know the market moves. Schwab is here to help you with it. So, whether you're buying, selling, holding, or planning, whether you're ETFing or 401k'ing, saving, spending, or even retiring, you can count on Schwab for market insights, live support, powerful trading platforms, and 400 branches. All at your service, all so you can invest your way. But that was nice, right?
I'm Bobby.
And I'm Jenny Horn. This is Next Gen Investing, where we track the trends shaping tomorrow's market.
From tech to energy, crypto to consumer, we focus on what's driving investor sentiment right now.
Clear analysis and forward-looking market coverage every trading day.
This is a make or break level for this stock. That could certainly be a short to near-term catalyst. Next Gen Investing, 1 p.m. Eastern.
Only on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you a long-term investor? Our investing webcast series breaks down different investing styles, including growth, value, income, and more. Best of all, you can ask questions by chatting directly with the education show. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Real-time access, data-driven analysis, from U.S. equities to global macro matters. Schwab Network connects the dots. Watch live, subscribe free at schwabnetwork.com.
We're back on Morning Trade Live. Here is the latest price action for the tech names that are reporting earnings after the close. It's going to be a big afternoon. We've got Adobe, Oracle, and Synopsys. So this is the price action, and we've got Synopsys lower by about 0.5%. Oracle is doing a similar thing. Obviously, there's going to be a lot of questioning around the CES spread there, and whether they can reassure certainly the market about that, and particularly given the blockbuster number that we got out of the company with future contracts that last quarter. Adobe is just underlying the upside, so certainly waiting for direction from that report. Let's go inside out on Adobe right now. Joining us is Keith Kirkpatrick, the research lead at Future. Thanks so much for joining us, Keith. So what are your expectations for Adobe? It just looks like investors are looking for some direction from that report given the price action right now.
Absolutely. Thanks for having me, Sam. So I think investors are really taking a closer look at how is Adobe actually monetizing AI. Honestly, if you look at what's going on in the market, there have been a lot of challengers that are trying to provide AI to promote things like content generation, as well as the actual production of content across that whole content supply chain. So what we're really looking to see is how is Adobe actually being able to go out and drive and derive revenue from their AI services. And I think we're going to see that. I think that Adobe's had a good story. I'm not sure whether it's just this irrational fear of investors that Adobe is going to be eaten by some of these competitors. What I think they're not really kind of taking into account is Adobe's bread and butter are these large enterprise customers who are looking for a platform-based approach. Adobe actually announced news over the past several months where they're making other models available within their own platform. So that really, to me, that gives me a lot of confidence that the company is actually going to be able to execute on its strategy.
Okay, yeah, Keith, but it's one thing to monetize, but part of the conversation that we've been hearing about, and actually Jim Cramer made the point earlier today as well, is that they need to lower their prices. So, they might be monetizing, but, you just wonder what that's doing for margins if, they would have to lower their prices because, he was making the point that people don't want the Lamborghini, they want the Ford here. Do you see that?
I think it's really going to depend on the market segment that you're looking at. If you're talking about large enterprise customers, I think they're going to still be willing to pay a premium for really, you're not just buying the technology, you're buying a company that has experience working with these very large customers. You're paying for the fact that, if you're talking about things like content generation, that the material is safe to use in a commercial setting. You're not going to be violating IP rights. You're not going to be running into any kind of copyright issues. Certainly at the lower end of the scale, yes, Adobe's always faced pressure from other companies that offer their product on either a premium basis or on a lower price point. So I think it really depends on the market segment.
One of the lines we've seen this morning is an announcement that they're actually going to be integrating ChatGPT into Photoshop here. I'm just wondering, what significance that has, how you're going to track those lines.
Sure. Well, actually, it's believed they're actually making Photoshop, Express, and Acrobat available through ChatGPT. The really doing a couple of things here. They're saying, okay, if you want to work with their tools within their platform, that's great. We're also making other models available within Adobe's platform. But they're also saying, hey, we realize that people are operating using other tools like ChatGPT. We're me. So what they're going to do is make their services, their creative tools available in the tool where users feel comfortable working. I think it's a great way to really address this big issue that we're seeing across the software landscape is letting people work where they're comfortable in the application, where they feel that they can get as much done as they can. So I think it's a great move.
Okay, Keith, and just lastly, obviously you want to see how they're monetizing AI, but what is the key number, the key metric that you're looking at? The meet or beat number, the one that's really going to be a standout that's going to drive markets and the price action?
I think it's really going to, look at what is going on in terms of Firefly. What kind of revenue are they deriving from Firefly? Because it really does kind of stem from how are their models, are we seeing growth in the utilization of their models moving forward?
Okay, looking at Firefly Services, you're saying it should be the first and foremost looking as we get an idea of how they're continuing to drive revenue there. We'll be watching. Thanks so much for the update and the preview for us, Keith. Kirkpatrick there, research lead at Futurum. Appreciate your time. Let's trade it now with Tom White, the host of Fast Market. So, an example trade for Adobe for us this morning, Tom.
Yeah, Sam, implied volatility elevated going into this report, to say the least. The bar is really low. The stock's down over 50% from its all-time highs that we hit 4 years ago. Remember, they were one of the big winners when NVIDIA came out, with the AI chips, right? Everybody thought Adobe was going to be able to take advantage of that. So it's pulled back over 20%. It's in bear market territory. So the bar is really low. The option market pricing at about a plus or minus 7% move either way in the shares, about $24 either way. So I looked at a strategy. You think the bar is low, you think it's going to rebound a little bit. This strategy takes advantage of it, and it takes advantage of the vol dispersion between different option series. So I looked at going out to the December 19th monthly options that expire in just 9 days. We're going to buy a call that's at the money, the 345 strike call. And then against it, we're going to sell in the near term December 12th weekly options that expire in just 2 days. We're going to go about that one standard deviation and sell the 370 strike call. So a bullish $25 wide call diagonal. You're going to pay roughly about a $10 debit for this call diagonal. So that's less than half the width of this bullish call diagonal to the upside. So the idea here is the stock goes up about that one standard deviation. That's where the max profitability is. You can see here from the risk profile. At or near that 370 level is going to be max profit on this type of trade. Anything above about 350 is going to be profitability on this one. So you do need a small percentage move to the upside to start seeing some gains on this trade. But I mentioned that vol dispersion that you're taking advantage of here. So out in that December 19th option series, where you're buying the 345 strike call, you're buying about a 67% implied volatility on aggregate. And then in the near term December 12th weekly options that expire in just 2 days, where you're selling that 370 call, you're selling about 116% implied volatility. So that dispersion really lowers the entry point price. You got $1,000 in risk on this per trade, but that can more than double if you get that move up towards 370. But as I mentioned on this type of trade, you only need that move to the upside. Now this is a bullish call diagonal. If you think the stock's going to rally post earnings about that one standard deviation, if you're more bearish, then you could do the put diagonal on this one. It's about the strategy due to the fact that we've got that dispersion between the implied volatility level between the option series.
Okay, Alicia, under a little bit of pressure just over the last few minutes or so as we look ahead to this key earnings report. Looking for monetization on AI. Thanks so much for getting us across the example trader for us today, Tom. Let's just check in with the markets very quickly. We're seeing a little bit of a mixed picture, but pretty quiet as we look ahead to this FOMC meeting. Just fractionally lower on the S&P 500 and the Nasdaq. We've got Dow and the Russell, which are both higher. Thanks for joining us here at Morning Trade Live. I'm Sam Vardis. Download the Schwab Network app available in the Apple App Store. Trade 350 with Marley next.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right broaden your knowledge of the platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
What is it that they're getting? A higher rate of change in sales based on their guidance, not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
The show's built for action. We break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Not inside. Actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
2025 kept investors on their toes. Now, get ready for the road ahead. Join Schwab's panel of experts on December 11th for 2026 Market Outlook, your guide to the forces shaping stocks, global markets, inflation, rates, and more. Hear from experts on where the markets may be headed, spot opportunities, and see what could drive your portfolio next year. Tune in on December 11th at 7 p.m. Eastern on Schwab Network. I'm Sam Vladis, live from the New York Stock Exchange. When the market moves, we're on it. Getting the reaction, the strategy, and sentiment in real time. Stream Schwab Network at schwabnetwork.com. Checking in with the 10-year, we are at 4.18. That's down 0.25% from yesterday. The dollar is down slightly, but still 99.06. On gold, we are trading slightly lower, a third of a percent lower at 42.2350. Crude oil really falling off that $60 a barrel mark, almost down 1% this morning, 57.76 a barrel right now. And Bitcoin trying to hold on to that above the 90,000 level. They did hit 93,000 yesterday, down more than 1% this morning though at 92,280. I do want to welcome in our first guest to our show today, joining us now, Kevin Green, our senior equity contributor here on the network, to take a look at Chewy. We saw Chewy fall after their earnings. They gave a really strong third quarter earnings, but a tepid outlook. Now they're higher. You know, walk us through the report, some of the reaction that we see, Kevin.
Yeah, you will see the market really gyrate here when you're looking at Chewy. Up about 1%, a little bit over 1% this morning. And you are seeing a little bit of a mixed reaction because of the earnings announcement, as you talked about. They actually reported a very strong quarter for Q3. Revenue came in at $3.12 billion. People looking for about $3.11 billion. But when you're looking at the adjusted earnings per share, that's where the street actually is very excited about this report. Coming in at 32 cents, Chewy looking for 14 cents. Now, the guidance moving forward, when you're looking at Q4, as well as their fiscal year 2025 guidance came in a little bit lighter than the street's expectations. Fiscal year 2025 net sales, they guided to $12.5 billion to $12.6 billion. Street was looking for $12.65 billion there. And their Q4 sales guide is between $3.24 billion and $3.26 billion. Street was looking for $3.27 billion. But you are seeing margin expansion within their business, so they are operating efficiently here. But they might be a little bit concerned about demand in the near term moving forward, which is why provided a conservative guide. If you're looking at the stock, and technically speaking, it has been consolidating since the end of October. So maybe you also have this enthusiasm in the market to really try to find a stock that's consolidating and potentially could break out to the upside. Why we are also seeing, once again, kind of this mixed reaction when it comes to this report. So they are still seeing demand, operational efficiency is pretty decent. We like the guidance moving forward, really why we're seeing this volatility right now.
Yeah, it's a really interesting response. We saw the shares dropping after they reported. Now we're up almost 2%. So we're really moving quite a bit here, as the market's trying to figure out their third quarter outperformance against this sort of tepid outlook. Why do you think the story here is different with Chewy than some of the other companies we've seen, where if they issued any guidance concerns at all, we've seen them just absolutely punished and hammered? Whereas Chewy, it seems that they're shrugging it off. Is it the technicals that you highlighted?
I think the technical is also a very low bar going into this report. If you kind of look at the stock, the last earnings announcement, we did see a pretty significant reaction to the downside. The stock was not able to really kind of hold in the key areas of resistance here. It has been trading around $32 level once again for about a month and a half or so. You can even say that there was an inverse head and shoulder pattern, which is actually very bullish for the stock. So you want to see a pretty decent report, not only just this quarter, but also the guidance moving forward. That probably could have created a reaction of buying activity taking place. And so, yes, I think there's a low bar. It does seem like there's anything wrong for the business internally. When you're looking at their metrics, they are expanding margins. Profitability should be there. It's just a top line growth. They might be pulling back their expectations because the consumer, as you know, might be a little bit stretched in some pockets of the market. And I think they're taking that into consideration in what the buyers got.
We appreciate you being with us this morning to take us through Chewy's earnings and some of the interesting reaction that we're seeing, the volatility in the stock today. Right now trading up about 1.7% at 35.43 for Chewy. I do want to welcome in our next guest, though, to talk about the Fed rate cut decision that we have coming up and the potential for a stand to rally, and it could be derailed by the decision today. Joining us now, Jeffrey Small, the managing partner at the Retirement Income Source. Jeffrey, thank you for being with us today. It is Fed Day. It's finally here. I'd love to know, just to start, what are your expectations for what we are going to get at 2 p.m. today, and also what we might hear in the press conference afterwards?
Well, I expect the hawkish tonality to continue, and there's still a chance we may not get a cut today because we're missing data. We have suboptimal economic perspectives right now, despite the declining job environment. So, there is a good chance we'll have a quarter-point rate cut, but there's nothing guaranteed at this point. If it's hawkishness, I think this is a sell the moment, or sell news event, and we'll see the market begin to sell off. Bearishness has been creeping in all morning in anticipation of Jerome Powell acting as the third year as being the financial Grinch in December. He has, kind of spoiled every Christmas tree around this type of program we've had so far, and so I expect that tonality to continue at this time. We just need to start to grow a little bit more. Like, if financial market grow, and we can lower rates, what kind of gift that would be for the American consumer,
So if we get the rate cut, honestly, you're one of the first guests who's actually brought up the possibility that we have no guarantee here. Yes, it is 90% factored in, and most people are expecting it, but there is no guarantee we're getting a cut today. Let's assume that we do. We do have several people who brought up to me the possibility that we may see a different Jerome Powell today than we normally see because he's on his way out. Do you think there's a possibility that we don't get what you call the Grinch Powell and we get a more open, more vocal Powell? Because at this point, he really has nothing to lose.
Well, there's always the chance for everybody starts to grow if they're used to playing the Grinch, right? Because nobody wants to be categorized as a Grinch. In this case, though, I say there's very little chance that's going to occur. I think he continues playing the Grinch financially in December like he has in the prior Decembers. And he's not going to be very dovish, he's going to be very hawkish. That's going to create more bearishness on the market. And I don't think the quarter point drop is really going to do very much for the rate environment anyway. Because the market has its own ideas. The credit market and the rate market have their own ideas right now, despite the Fed being dislocated, for the last 18 months. And so the Fed lowers rates and the rates go up. And so I expect that trend to continue because there's a lot of other influences affecting rates besides the Fed, who appears to be very, what I would say, behind the curve and somewhat predictable at this time.
All right, so one of the other things that we're talking constantly about through this December seasonality and also over the last month is the potential for an AI bubble. I'd love to get your thoughts on that. If you think, one, the concerns are warranted, two, if you think they're going to continue, and how that impacts us into the end of the year and into 2026.
Well, we've all heard for the last 3 months that the word bubble about 100 times a day. So there's a huge difference between the 2000 bubble and today's bubble, where companies are actually making money, and there's no threat of companies running out of money. That's really what precipitated the 2000 collapse for the great dot-com bust. And so I think going forward, AI is about a lot of traction. Companies like NVIDIA are grotesquely misunderstood. They're more of a long-duration AI utility rather than a cyclical semiconductor name. And they're being treated as a semiconductor name at this time, where valuations of Avago and AMD are much higher in terms of their metrics than NVIDIA's are. So that's just one example. But I think in the long-term utility, AI is here to stay. The projection of job increases in the next 5 years are 18 million from the additive AI, just domestically speaking, globally 45 million people. So the AI is not going anywhere. It's time for folks to realize that and stop treating NVIDIA like a typical semiconductor play, and it's not.
All right, let's talk about NVIDIA. You say that it's grotesquely misunderstood. Right now, PE in the low 30s, which is lower than Microsoft, Apple, Amazon right now. What do you think the disconnect is there, and why do you think NVIDIA is so misunderstood?
Well, we've never had a market cap this big, and quite frankly, it freaks out investors in terms of what can go wrong. A lot of the naysayers, especially some of the very famous people on Wall Street, have been waiting for that negative quarter to come. It's never happened. When's the competitor going to come out and unseat them? When are they going to have some demand? I mean, NVIDIA's ramp rates here are ridiculous. They're run about $213 billion for this year in terms of total revenue. By 27, we were on $316 billion, and their free cash flow improved from $80 billion to about $120 billion by 27. And I think you've got to utilize this opportunity to buy the oil and realize they are a long-duration AI utility play, as they really are. The AI Bible, so to speak, for the lack of a better metaphor or connection to them. So I think you've got to get on board.
Do you think NVIDIA is your number one pick in the tech space then?
It is. It's absolutely my number one pick in the tech space right now. Not selling AI, but Jackson is the godfather of AI.
No, I didn't.
The entire semiconductor sector
What happened?
benefit as well. Money continually gets reinvested in the direction of this new tech.
And who else do you like in the tech space?
Well, I think the biggest AI play, we've heard about this for months, and I apologize for saying the same story different day, but Tesla is the biggest AI player right now in terms of their autonomous robotics, and of course their autonomous driving. And so that is really the biggest story. Of course, we still are fruition. That's a couple $1 trillion of extra market cap added over the next 3 to 5 years to Tesla. Puts it in the same neighborhood or category valuation potentially as NVIDIA as time marches on here. But a lot of stuff has to materialize. And so if you're looking for, where is the big growth going to be coming from in the Magnificent Seven side of the equation? Tesla has the most upside growth at this time, but that means they also have the most upside risk because it is trading at 209 times earnings present moment.
So you've got some major mega cap AI names there in Tesla and NVIDIA. How do you balance conviction here with your concentration risk?
Well, I think the proof. You try to use proof if you can, as much proof as possible. Marley, we only have to be right 60% of the time in our industry to be successful, and so nobody knows for certain. But I think think, you watch what the company's doing, you see how they're trending, see what's happening, and hopefully there's no bad news. They're making progress. And so if we're sitting here in 12 months and the robo-taxis in 25 cities nationally, I mean, we're looking at a $600 minimum stock price on Tesla. And so, of course, we're looking for the expand side on the equation. And, of course, the advent of, the robotics coming to the equation and coming to market over the next 12 months.
Jeffrey, you're mentioning a lot of long-term plays here. So for my last question, if we were to sit down a year from now, what do you think will have been the biggest surprise in the market narrative?
That tech is leading again. Unfortunately or fortunately, that's the same story, different day. The tech is going to lead the market. The concentration is going to get larger. The rest of the market contagion will catch by way of the advent of their integration of AI into the different sectors. And tech will improve the profitability of all these. And so those two are directly correlated. And I think it's very important for folks not to realize that those are not disconnected at all. Those are connected. And if the broader market does decide to catch up to tech, the reason for that will be the enhancement of profitability from tech itself in AI. And it will reshape our economy, and it will reshape the rest of the publicly traded companies in the S&P for the ones that embrace it.
Well, Jeffrey, we appreciate you being with us to talk through all of this. That's Jeffrey Small, managing partner at the Retirement Income Source. And we've got plenty more to come on Trading 360. Next, of course, we've got the big three. 3 stocks, 3 charts, and 3 trades. Rick Ducat will be here to take us through the technicals. And Don Kaufman will take us through the trades for ExxonMobil, JP Morgan Chase, and the bond ETF TLC. That's next on Trading 360 on Schwab Network.
Live on the floor of the New York Stock Exchange, the countdown, the setups, the stories that make markets move. Minute by minute breakdown of the biggest headlines, earnings, and global movers, just the trades that matter. As the bell hits and the markets react in real time, opening bell live at the NYSE, right where it counts.
Believe me, when it comes to investing, you'll love Carl's Way. Take a look here, please. But there's Carl's Way is the best way. Thank you.
At Schwab, how I choose to invest is up to me.
Exactly. I can invest in trade my own.
Yes, and I let them manage some investments for me too.
Let's move on, shall we? No can do.
Look it up there.
Where are you going?
Schwab. Schwab, a modern approach to wealth management.
Welcome back to Trading 360. I'm Harley Caden. It's time for the big three. We've got 3 stocks, 3 charts, and 3 trades. Rick Ducat will take us through the charts, and here to take us through the trades is Don Kaufman from Theo Trade. Great to have you both with us as always. Don, you know the drill. Big picture thought, it's Fed Day. We are seeing a bit of a mixed picture right now as I take a look at the big board ahead of the decision at 2 p.m. Eastern. What are your thoughts on the action we're seeing?
Yeah, this marketplace right now has got some pent-up volatility, if you will, and it's all waiting specifically for this Fed announcement. I mean, start to look out even past the Fed announcement. Let's not even decide what that's going to look like, but into Thursday and Friday, this marketplace is going to move. And we're trading basically in the exact same range for the last, 7 trading sessions. So, again, look for some big movement off of this Fed announcement. But more as a catalyst than anything. It seems like, look, the cut is effectively priced in. I am of the opinion it's 25 basis points, but whether he's going to have that hawkish tone or not is really, I think, why we have that pent-up volatility.
All right, Don, so we're going to get to your first pick for the big three. I know you like to be a bear, but I have a feeling based on the news and taking a look at the charts on this one that we may have a bullish trade on our hands here. We've got ExxonMobil. They did just raise their forecast for their earnings, for production, for some of their margin numbers. Walk us through this first pick. And are you bullish or bearish on this one?
I am going to take the bullish side right off the bat. Here we go. I'm going to take the bullish side on XOM. And what I'm looking at over here just happens to be, well, we're kind of butting up against some of the all-time highs. Like new highs in and around, that 120-ish. All we have to do is hit right into the 120 and let retail basically come and do the rest. And what I mean by that is, once again, we're looking at kind of a squeeze situation. I've been looking at these very, very often, looking for stuff that's butting up against all-time highs or, multiple year highs. When I say let the retail, traders come in and do the work, we hit 119, 120, which is pretty much where we're trading right now at ExxonMobil. And what you're going to see is retail call buying is actually going to burst the stock, if you will, to the upside. It's got a high probability of doing just that. So in ExxonMobil, I'm looking for retail to kind of take us to some of those highs by, in fact, buying calls. So I'm going to go out to the January 16th expiration. I'm going to give myself a little bit of time over here. We're going to hit the holidays. Things can kind of slow down. Jan 16 expiration. I'm going to buy the 120 call, and I'm going to sell the 125 call. So it's a very slightly out-of-the-money call spread. It's a $5 wide call spread done for a $1.55 debit. All predicated on the idea that we're, again, going to kind of break out to the upside here.
All right, so as we look at the technicals here, Rick, on ExxonMobil, I can see we've got an upward sloping channel. We know that they've been moving to the upside here. What do the technicals indicate to us?
Right, very close to that 120 resistance level that Don highlighted here. Our pink line, if you backtrack, you can see that was a notable high right before we had our severe decline heading into that tariff news announcement shock that gave us our low point here for the year. Since then, we've recovered. Our green line here, 150 and 50, was our high point. See how frequently that was another stopping point for price here before this period of chopping, gradually grinding upward prices here. For now, though, we still haven't taken out these old intraday highs near 120.80, even though our trend line going along the lows has pretty much held firm. So now we are quite close to that resistance area. We haven't gotten the breakout just yet here, but a push above that area could trigger the cascade of orders that leads to that very energetic price reaction that can happen sometimes here. When we see our moving averages, yellow 21-day comes in just below 117. That could be a short-term supported area, but some traders might have their eye here instead. The orange 63-day EMA near 115 lines up quite closely with our trend line, as well as our repeated resistance area, our green line 1550. So that could be a more noteworthy area to follow. When we look at momentum, RSI has been very gradually compressing in a triangular type pattern here. For now, though, we are above the 50 midline. We are making new relative highs along with price here. So that would be more of an encouraging sign for the bullish crowd. When we look at volume profile next, we can see that our node that we have closest here, right around that same 115 level once more. So a key downside area there to watch out for. We also have a bit lower, 112 or so. 112.50 was the low points that we saw here. This area also includes our 252-day EMA and our volume profile point of control. So notable supportive areas there. If we do keep moving higher, plus 2 standard deviation channel currently comes in just below 123. That could be an upside area to keep an eye on.
And trading just below that resistance level that you both highlighted right now at 119.42. So we're close to 60 cents off of that level for right now. Your next pick, Don, though, JP Morgan had a bit of a rough day yesterday, traded down more than 4% to close the day after their spend for 2026 maybe a little bit higher than expected.
Yeah, so, I took that into account, but my trade, this next trade here on JPM is going to technically be bearish, and it's kind of significant bearish call.
So right now, JP Morgan has actually been trading weak relative to the financials. When I do trade, I don't necessarily like to look at like one underlying. I like to look at that underlying versus peers in the sector. And this is, one of the biggest and best in terms of the financials. And it has been, again, weak on a relative basis. The other aspect is you're going to see in the technicals, this thing's been, if you will, stuck in the middle with you. It's trading 300, 320, 300, 320. It's stuck with a nail in its foot. This recent break yesterday, I think, is actually going to take us into some lows. We're going to break through 300, and away we go. And that's exactly how I'm going to trade it. I'm going to look for the break under that 300 to ultimately trigger a nice bearish trade. The trade is all the way out to the February 20th expiration. So this one I'm really kind of giving myself the gift of time. It's not that I don't feel really secure in it. It's, look, JP Morgan's going to have earnings coming out in January. I want nothing to do with that because it kind of becomes a little bit of a coin toss. But I'll bear it up, and I'm going to give myself plenty of time for this to kind of play out. I'm going to buy the 285 puts, and I'm going to sell the 275 puts. So it's a big $10 wide spread done way out February 20th for a $2.30 debit. And that's risk reward if this stock does break down.
All right, so as we take a look here at JP Morgan, if they do break down, I see we're going to walk through some of it. I see you have convergence there over in your chart here. But as we're looking at technicals, walk us through what we're seeing here. You can see that they were moving to the upside, but as Don pointed out, underperforming some of the other financials.
Right, so 285 to 275, right about here. That's the area that you would be looking at for that type of trade. And if you backtrack, 280 was an important level here. It was a little high point. It's where we had our breakout point. It's where we touched once again at support, and old resistance became new support, and then we had rallied from there. So 280 stood out to me. Also 292, our darker green line here, notable low points several times here, with the corresponding ceiling around this area near 318. We had our highs 322.25, but that didn't last. It was a very quick retracement here back down to that support area. So range bound, as Don said here. You could also draw a trend line going across these lows here, giving us our white trend line. That's about where we bottomed out yesterday. We did make an intraday move below that point here, but we have recovered somewhat today. So look out to see if that continues to hold any significance going forward. If we do start to break below that trend line, it could open the door to 292. So now we can see our moving averages that we follow. 21-day and 63-day, or yellow and orange respectively, pretty close together, near about 305 to 308 or so. So that would be another resistance confluence for price to push above here. A close above those levels would signify perhaps some strength here, but really we would want to see a breakout from beyond this range one way or the other to see an increasing measure of directionality here. Kind of like our last chart, RSI compressing in a more triangular pattern here. We are in the lower end of the spectrum. This time, though, we're below the 50 midline, even though we did hang on to that green trend line there. So you would want RSI and price to be moving in tandem here, so look out for that as well. Our volume profile study shows here we have a volume node near about 310, and we also have one here near about 300. So those are kind of the two potential congestion areas for price to be on the lookout for. And if we were to move lower, 292, our level we highlighted earlier, that's where the volume really starts to drop off below that point too. So you could see some fast moving prices there. And then 275, the area that we mentioned before from Don's trade, that's where the next volume node is to the downside. So that also stands out as potentially supportive.
Right now, 306.32, trading up more than 25% so far on the year for JP Morgan. This last pick, I'm guessing, is Fed related. You've got the TLT bond ETF in here. We've certainly been talking about bonds in advance of the Fed decision here, and also with Jerome Powell's departure and a new Fed chair coming in. Walk us through this pick.
Yeah, this is it. This is Fed trade. This is, you have to throw your hat in the ring for Fed announcement. This next trade, though, is only going to be literally between now and Friday's expiration. I'm actually going to hop on trend in the TLT. So here's the whole take for the Fed announcement. They come out, they cut a quarter point, but the question is, what's Jerome Powell's tone going to be? Is he going to be hawkish, or is he just going to clear, stay quiet? stay quiet ultimately until May and go into retirement very, very quietly. And I have questions about that one. Is he going to fight a little bit? Fight current administration? Obviously, they want to lower rates. He's going to lower rates, but you might hear a little bit of a hawkish tone, and that is really the camp that I am in. And I'm in that camp simply because we don't have enough data to support it. There might still be inflation going on. There's more questions than there are answers. We have to take a hawkish tone. As such, what I'm going to do is just going to go to the TLT. I'm going to hop on trend. TLT has been selling off a little bit lately. I'm just going to go to the December 12th expiration. That's this Friday. This is moving all the line over here, right? I'm going to buy an 87.5 put. It's trading for somewhere in the neighborhood of about 27 cents right now. It was around almost penny for penny with TLT's cheap shot for the downside, looking for, again, some of that hawkish tone and bearishness in the TLT right here in the near term.
All right, so as we look at the TLT, we know how erratic the bond market has been. Obviously that will be reflected here. What is the technical showing us?
So 87.23 was the break even on the trade. 87.25 is the area that I highlighted here because it was a series of high points that we had before our breakout to the upside. Now things seem to have fizzled a little bit here. We do have this gap to look out for to the upside between 89.16 and 89.95. That was the high point after our gap here, so that would be an area that the bulls would want to clear. But then we can see here that we also had a low point, 85.50, small gap there. That was the low point 2 times after that as well. So a couple areas to watch in terms of our horizontal price levels. Now when we look at our moving averages, they are clustered together right on top of each other here. Here about 89 or so. Clustered moving averages typically suggest either price activity that's so choppy it's not really able to find a direction in terms of moving averages or more range-bound trading. In this case, it seems to be more of a chop, kind of like just a lot of big swings that we've seen for this product here. But now, though, we can see the faster moving average, our yellow 21 day, is crossing below its slower moving peers, which is a sign of the bearish trend could be accelerating here. RSI also shows this. We have a downward sloping trend line. We're below the 50 midline. We were making new relative lows during the past couple of sessions here. So, more of a bearish lean according to this indicator. Volume profile shows that we have some big volume areas here. 86.68 is where the point of control comes in. That also lines up with our -1 standard deviation channel. So 1 standard deviation below our heel linear regression line. So that would be an important area to the downside. Also 88, right about where we are now. That's another node. And then a heavy trading area above that really starts to thin out once you get beyond 90. That's where things really start to drop off.
All right, with this one, with this TLT looking for that 87.50 put right now at the 88.33 with a very short play here with a Friday expiration. We'll get that decision later today at 2 Eastern. Don, I want to thank you for being with us. Don Fox, the co-founder of Trade, and of course, Rick Ducat, our lead market technician here on the network for breaking down the technicals. Coming up next, we're going to find sale points earnings surprise and why the fourth quarter outlook fell short of investor expectations. The CEO joins us to break it all down next.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Morning movers, be the first to find out what's shaping early market action. Check, options corner, futures focus, technical analysis. Morning movers covers it all. Grab your coffee and tune in every trading day at 8 a.m. Eastern, only on Schwab Network.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
with the data and the decisions moving markets. Morning Trade Live breaks down the macro moves driving the price action, from Fed policy to global growth to inflation prints and geopolitical risk. Smart, fast, and always live from Wall Street to your screen. Morning Trade Live, where the markets meet the macro, weekdays at 10 a.m. Eastern on Schwab Network. Stay connected to what moves the market. Download the Schwab Network app and stream anytime wherever you are. Welcome back to Trading 360. I'm Marley Caden, live in our Chicago headquarters. It's time now to spotlight SailPoint, whose earnings topped expectations. Joining us now is Mark McLean, founder and CEO of SailPoint. Mark, thank you for taking the time to be with us this morning. We really appreciate it. Before we dive into your earnings and your outlook, would you mind just telling our viewers a little bit about SailPoint?
Sure, and thanks, Marley, for having me on the show. Really appreciate the opportunity. Yeah, look, SailPoint's in the space we call identity security, and there's a number of aspects to that market space. The one often people are familiar with is what's called single sign-on or multi-factor. The way we log into applications and often get challenged with a second authentication, like a text on our phone or something. We're in the space in the enterprise, which is really the challenging thing. It's called identity governance, which is how do you make sure that the right people, and now as agentic and machine identities come to the forefront, the right things, so the right people are the right things, how do you make sure they have access to the appropriate data and information that they're supposed to? And this has everything to do with identity now being a primary vector for compromise by the bad actors. The new phrase is that the bad actors don't break in, they try to log in. Right? They're trying to compromise identity so they can get into the enterprise and compromise or steal data. That's where we help protect that.
And Mark, for the third quarter, you saw your revenue jump 20%, your ARR grew 28%, your earnings beat expectation, you swung from a loss to an 8-cent profit here. What are some of the key drivers behind that operational turnaround?
Well, well, due respect to what we call a turnaround, we just think that on a nice trajectory, frankly, and I think at the same time, it's a testament to the strength of this market space. I think as people continue to recognize this trend in the security landscape toward this identity vector as an attack vector. Marty, just to kind of give you a broader perspective, I know folks don't live in security all the day like we do, but most folks are familiar with things like endpoint or device protection. I need to protect my laptop or my iPad. They're familiar with network protection. I need to keep the bad guys from getting onto my network. They're familiar with the cloud protection now, like how do you protect the data that's loading up in the cloud. Identity is a relatively newer area of focus in security, partly because it's become such a clear target of the bad guys, partly because in today's world, those other vectors, while important, often aren't even part of the equation you need to protect. You're often on your own device, not the company's device, logging into something in the cloud that your company doesn't technically own, right? So you have to say, who or what is this identity trying to access my data? It's that focus on identity that's still emerging and relatively new, but the uptake has been strong. We're at about half of the Fortune 500 now, about a quarter of the Global 2000. Big companies around the world are recognizing this problem and trying to position themselves for better protection.
And Mark, we've seen a bit of a strange pattern across some of the cybersecurity stocks. CrowdStrike, Zscaler, of course, now SailPoint. Strong results, beats, and then we're seeing some stock declines in the wake of this. I know for you it's your second straight quarter where you had an earnings beat and then saw this interesting performance in terms of stock. Do you think this is an industry-wide sentiment issue, something specific to the identity security space? What are investors missing here, specifically when it relates to SailPoint?
It's a great question, Marley, and I can honestly tell you we talk about that some ourselves, as you might imagine. But at some level, there's a couple things going on for sure. One is, while we were public for almost 5 years, from 2017 to about 2022, we went private with Colorado and then re-emerged as a public company in February of this year. But as a result, we're considered a, quote, new issue, a newly public company. And I think part of what you see in a, quote, risk-off environment, and some core investors are taking kind of a risk-off approach, is new issues are often one of the things that gets pulled back on because it's considered riskier. This is a newer, less proven story. So we know there's some of that happening in the marketplace. And I think, as you said, there's just a sense that security is kind of hard for people to understand all the moving parts. And at some level, sometimes investors are looking for just almost perfection in every part of the business. We're we're delivering high-end results. We're growing fast. We're getting slightly more profitable. We're putting those guidance numbers out to say we believe we can continue to do this. And so sometimes it really is almost puzzling. What else do you want from us, so to speak, in the market? We're doing everything we can to show you that this is a healthy, growing business, and we feel great about it. And I think some of that recovery you saw yesterday afternoon, and we're seeing it a little more this morning, is people really hearing the story in more nuance than just the algorithms that sometimes respond very quickly to earnings. And I think we feel good about the message is resonating.
Yeah, and as you mentioned, your stock's up about 1% today. So we are seeing some recovery here. But I want to talk about identity security. It's becoming increasingly mission critical. It's something that I find myself saying more regularly now in these security conversations. Do you think the market is undervaluing the recurring revenue companies like SailPoint, given the valuation pressure that we've seen since, as you mentioned, you are considered a newer to market since the IPO, which is 3 quarters ago now?
It's all great thoughts. We do believe that in general markets are still fans of ARR, annual recurring revenue, right? We were a classic, about 20-year-old business, and crossed over $1 billion this quarter. That's kind of a big deal, right? And at the same time, we were once a software perpetual license business that shifted to recurring revenue and very predominantly SaaS now, a true SaaS hosted offering, which is sort of everything the market wants. Give me SaaS, give me recurring revenue. And we're that's our business. That's the core of our business now. So we feel like they like those models. They like the predictability of those models. I think generally people like enterprise businesses when they see a level of stickiness, right? That this is a very sticky technology. It's something we don't maybe talk enough about. That the nature of what we do is we have to integrate with all of these internal systems at the organizations we serve. Well, as a result, deployments are somewhat challenging and complex. On the other side of that deployment, though, you're very sticky. We have some of the highest gross revenue retention rates in the industry because once people select and go forward with SailPoint, they are very unlikely to come away from us. So as we build this momentum over time and deliver more value and deliver more things that the customers need to help us protect against emerging threats like AI and what's happening with agentic technologies in their shops, that seems to continue to build the momentum we think investors will like.
Yeah, customer retention is the good kind of stickiness. That's what we want, Mark. Exactly. So my final question, I guess, is that for investors who are watching today, do you view SailPoint as a defensive safe haven in enterprise security, or are you a now more growth-oriented bet on AI, cloud, and this hybrid security transformation play?
Bit of both. I think there's a safety in it. It's very strong, deep technology that they need to manage their human identity landscape. But as all these newer technologies are emerging, there's a lot of focus on making sure that they can protect that as well. And so I think we have some advantages of being kind of traditionally strong core technology they need, but also kind of on the growth curve for things like AI and agentic. So we feel really good about that position.
Mark, we appreciate you taking the time to tell us more about SailPoint today. That's Mark McClain, the founder and CEO of SailPoint. SailPoint shares trading up 0.75% right now after their earnings beat. Coming up next, we've got the disruptors. We'll be taking a look at Oracle ahead of their earnings. Stay with us. Staying connected to the markets, the Schwab Network. Tune in 24 hours a day, 7 days a week on SchwabNetwork.com and on all your favorite streaming services. Schwab Network, available anytime, anywhere, on any device for free.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. You love using charts when analyzing your stocks? Our technical analysis webcast series breaks down different charting techniques like trend analysis, price patterns, moving averages, oscillators, and much more. Best of all, you can ask questions directly to an education coach. It's interactive learning at its finest. Tune in live or on demand. Head over to schwab.com/coaching and start learning today.
Welcome back to Trading 360. I'm Marley Caden here in our Chicago headquarters. Let's head out to the New York Stock Exchange for a check on the markets. Welcome in Nicole Cavallini, the host of Opening Bell and the watch list here on Schwab Network. Good morning to you, Nicole. We're 2 hours into the trading day on this all-important Fed day. direction. We got a bit of a mixed picture here. What's catching your eye so far today? Well, I looked out there because as soon as the bell rang here this morning, I watched the Dow Jones Industrial Average go over the unchanged line 4 times in just a few seconds. The search for direction ahead of Fed Day at 2 p.m. Eastern Time. Now it seems evident that they're doing more buying and selling here on Wall Street, up volume outpacing down volume, and most of the sectors are in the green. Only tech and utilities are showing weakness. The rest are all in the green today. So that's good news. Industrial, consumer, discretionary, healthcare, financial, leading the way. And good names that have been really exciting, like GE Vernova, which we'll talk about in a moment, hitting some new highs, and many others that are leading the way. Nike, American Express, Johnson & Johnson. The idea here is that the Fed will cut today, 25 basis points, and the market is counting on that. But will it be a hawkish cut or a dovish cut? A lot of folks are betting that it might be a hawkish cut in that we'll get the cut, but then we might not get signs of another one. In fact, there are folks saying maybe it's Jay Powell's last cut. So everybody's going to be hanging on to every single word in that Q&A at 2:30 p.m. Eastern Time. The 25 bits at the top of the two, I think people will take that in stride, but it's going to be that language later. At the same time, you have President Zelensky talking about Ukraine and the U.S. holding talks on the peace plan draft. That always seems like good news ultimately. And other stories that have been circling, but I would say that those are the biggest of the bunch. And also, mortgage apps have been on the rise, really is the refinancing. And we'll have Adobe, Oracle, and Synopsys today after the bell. Looking forward to those as well, Marley.
Yes, so big earnings coming out after the close today. But let's talk about GE Vernova. You mentioned them as something that caught your eye, moving considerably higher. Shares up more than 13% after some announcements they made during their investor day. Can you tell us some of the highlights?
Yeah, indeed. I mean, you see this big gap higher to new all-time highs. Spun off from General Electric in 2024, but it's all good things. I mean, they had their investor day, and all the analysts have now jumped on board. They love the outlook for the future for GE Vernova. I mean, when you think about the supplier of electric generation equipment and what drives a company like this, data centers, AI, electrification of the economy, there's just so much demand for electric story and it's helping names like GE Vernova. I mean, for example, you have JP Morgan with an overweight rating and in fact a $1,000 price target. It's at 707 today. Bank of America put an 804 price target and kept their buy rating. They really like that 2028 outlook. I saw OXO with an 855 buy rating. So it shows you what the analysts on Wall Street are feeling about names that's already year to date up 115%. The company says it's raising its projections for revenue, cash flow growth, doubling the dividend, increasing the buyback, and really it's an expert in high and medium voltage technologies as well as integrated systems. And the CEO has been so positive. Scott Chadwick is saying how we're going to generate a lot of cash and that is going to give us a chance to really play offensively. So just raising all the numbers across the board and based on a day like this, Investor Day, and all these analyst calls, doesn't it seem incredible? Nothing is a sure thing, but boy, it's exciting to watch a game like this one today, Marley.
It certainly is. Anytime you see a double-digit move to the upside, it's exciting to watch. Thanks for breaking that down for us, GE Vernova. That's Nicole Catalini. And now it's time for the disruptors. We've got George Tillis, our senior markets correspondent here with today's company. We're of course talking about Oracle. The company reports earnings after the close today. We'll be covering them on market and on close. As far as expectations, George, what's the street looking for Oracle?
Well, I think you look at the expectations for the quarter, they're actually relatively modest. You have to consider, first off, Oracle's movement in the last year has been very remarkable, just going back to, June quarter, all the way up till September, where the stock just gapped higher significantly based upon remaining performance obligations, which actually were, if you look at the reported RPOs going back to the end of fiscal year 25 for Q4, they were around 138 billion, and then when they reported last earnings numbers, that increased substantially to about 455 billion. That was about 350% increase, just roughly speaking, year to year. So essentially the stock gapped to the upside significantly, and this is all part and parcel of what's happening with Oracle, moving more so into the agentic AI space outside of its core business from an enterprise resource management software space. Now, what's happened since then is the stock has backfilled all of that move, all the way back to the second quarter of last year. Now, if you look at the estimated revenue EPS for the quarter that Goldman report, you can actually see it's modest in the context that it seems to be based on core business, not the RPO business that they have going for them, expected until 2030, which is quite large. So EPS is $1.64. That's about 11% higher compared to last year. If you look at sales, around $16.19 billion. That's higher by about 14% year over year. So what's happening here, I think, to be honest with you, Marley, is that one of the things that Oracle did not disclose in terms of that huge RPO backlog is which customers are essentially paying for that or contingent payments for that number. Some estimates have that OpenAI alone was about $300 billion of that, and I think that the struggle for Oracle since last quarter, which was a pretty remarkable move, was that OpenAI may not have the capacity, at least right now, to pay it. And that's why we're seeing the entire move from the September quarter report just evaporate.
Yeah, and we've seen that fall, as you mentioned, just in the last month down more than 8% for Oracle. So a very interesting setup coming into earnings. And I know when you're structuring an example trade, particularly on an earnings day, it can complicate things, predicting that movement and what they're going to say. So as you approach this example trade for Oracle with their earnings after the close, George, how would you structure it?
Yeah, so if you look at last quarter, and I remember covering this, the expected market maker move was essentially like $20. Effectively, they ended up with a $100 move. So that was a 5 sigma move. That was a very outsized move. This quarter around, based on the retracement of the stock, and again, the uncertainty around the RPOs, I don't expect that kind of move. Now, when you look at the market maker move for this quarter's report, it's around $22 or so, about 10%, roughly speaking. Once again, so what we do is I think there's a bias tilt to the upside, so let's skew a neutral on our condor here, about 1.5 times the upside market maker move, which places it around 255, coincidentally, that's around 50-30 to the average the stock price will have. And then on the downside, I'm going to structure it 1 time market maker move around $20. So essentially the structure is this: going up December, next week, 9 days expiration, I'm going to sell 255, 265, call spread on the current price and below the current price. I'm going to sell 200, 190 put spread. And altogether, you could generate about $3 in credit or $3 contract. So the whole premise behind the trade is range bound. There's more flexibility or skew to the upside just in case there's a surprise. And then, of course, the max profit is achieved when we first start 255 by 200 low. Break even at 258, high and 197 low, and then we're already $3, the risk is $7 on this trade. So for what it's worth, again, it's more a neutral trade with a bullish tilt or skew to it.
All right, George, we appreciate you being with us for the latest on Oracle expectations ahead of the very short offer for that example trade right now. Oracle trading down about 30% to 2085 in advance of earnings sector. Killing, thanks again. Coming up next, we've got our 360 round. We're going to take a look ahead at the Fed's rate decision, which is expected later today. Expectations calling for another 25 basis point cut. We'll dive into that next on Trade 360.
Trading Schwab is powered by America, unlocking the power of thinking smart, rewarding trading platforms. Bring your trades into focus on thinkorswim desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
And I'm Jenny Moore. This is Matt Sunny Investing, where we track the trends shaping tomorrow's market. From tech to energy to the food. Clear analysis and forward-looking market coverage every trading day.
This is a super great level for this stock. And that could certainly be short to near-term arrows. And that is once we have Eastern.
Only on Schwab Network. Welcome back to Trading 360. I'm Marnie panel to discuss expectations for the Fed announcements today. Joining us now, Bill Lee, the chief economist at Milken Institute and Global Economic Advisors, and Ben Ayer, senior economist at Nationwide. Thank you so much, both of you, for being with us on Fed Day. You know, Bill, I saw your notes in advance of our talk. You said that you're warning the Fed is behind the curve and risking a policy mistake if it doesn't cut today. So what are your expectations for today, both in the cut and how big it will be, but also even potentially more importantly, what your own counsel say at the press conference afterwards?
It's really going to be a challenge for Chair Powell right now because a significant chunk of the FOMC is really trying to fight the last battle of inflation. Even though the events that have happened, the stagflation, the fears of tariff-driven inflation are starting to wane pretty quickly. I mean, after all, when was the last time we heard tariffs in the news, right? And the GDP growth is hitting almost 4% or better for current estimates. There's really no hint of that stagflation showing up. But the Fed is so concerned about the service sector inflation that is popping up and staying fairly high that a lot of the FOMC committee is going to dissent, saying, well, we really think rates should remain high, even though the labor market has become softer and softer as we go on. So Chair Powell's going to face that challenge of threading the needle. He's going to have to say, we are unified, believe it or not. We are going to make the right decision, and we're going to cut today because the markets expect us to cut. But we may pause in January or early next year until we get more visibility. I think that's the key word you're going to have to listen for, which is that they're going to say, we don't have enough data to make a decision further out, and we're going to wait for the data. And I think as long as the hawkish members of the FOMC are voicing themselves so vocally, and because Chair Powell is lame duck, we may have markets, misguided by the notion that they may actually hold at these higher interest rates.
And Ben, coming over to you, Bill used a very interesting word there in that answer. He said unified Fed. Now, I know we'll get a decision today because they have to make one, but are you expecting a divided Fed that just comes to a consensus? And how divided of a Fed are you expecting?
Yeah, division is still, I think, the key word when you look at the Fed right now, unfortunately, because there's a lot of variables going into the direction. And I think that visibility term is very key as well. We're still getting some of the data that was delayed over the government shutdown. So I do think the Fed is going to cut today. I don't think it's going to be a complete consensus, though. I think we're going to get a couple of dissents, just as we've seen in recent months. And that's going to play out as we go into 2026. I agree the commentary from Chair Powell will be about potentially pausing. We won't see as much of a movement on things in early 2026, but there still are the two sides of the coin here. And I think the push for lower rates coming from potentially a shadow Fed chair early in 2026 might push us to some cuts later in the year.
And Bill, you were mentioning service inflation there in your last answer, and service inflation is showing signs that it's becoming immune to additional monetary tightening. So if that is in fact the case, does that imply that rate hikes or even pauses are even effective policy tools anymore?
Well, ask yourself the question, is your doctor going to be lowering his prices because rates are high? Yes or no? And I think the service sector has always been the stubborn one. And the one nice thing about the Fed is that it targets the entire CPI. And as goods prices start to disinflate, and as the rate of inflation there is starting to come down, way down because of energy prices, we're going to see a moderation in the overall CPI. That's really what the Fed cares about. But the stubbornness is really in the interest-resistant sectors of the service sector. And while the hawkish members of the FOMC can cry as much as they want, their high rates are not going to hold back the ability of dentists and doctors and other service sector workers to keep their prices high.
And Ben, you brought up a really good point. We've been in a data blackout because of the government shutdown. They're missing a lot of these key factors that they usually use to make these decisions. So with that, you said there could be some holes in place. We're also going to get a new Fed chair potentially in that time, depending on how long that hold is. What needs to happen between now and then? What kind of data do they need to see? Do we need a different Fed chair? Or what does the Fed need to feel comfortable to continue the easing cycle?
I think the labor market really holds the key here, because that's been the focus from the dovish arm of the FOMC here in recent months, and is going to be put out there as the main reason why we're likely to see a cut today. I think inflation is going to be in the conversation, certainly, and certainly we're going to see potentially some more impact from tariffs on the inflation story in early 2026. But I still come back to the labor market. And I think if we see the labor market continue to be soft and not see much hiring, particularly from the service sector, early in 2026, I think there will be renewed calls to potentially lower rates. And I think the focus on the softness and the weakness for the hiring front and what that could mean for consumers is probably still the main linchpin for if we see more cuts next year.
Well, I appreciate you both being with us on this important rate cut decision day to walk through some of the expectations. Bill Lee, Chief Economist at Milken Institute and Global Economic Advisors, and Ben Ayers, the Senior Economist for Nationwide. We will, of course, have an extended edition of the Watch List today to cover that decision at 2 p.m. Eastern, and we'll continue talking about it on Market on Close after that. I want to thank you all for joining us today on Trading 360, though. I'm Carly Caden. You can download the free Schwab Network app available in the Apple App Store and tune in 24/7 on schwabnetwork.com. Fast Market with Diane King Hall is coming up next.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Welcome to Schwab Network, where real-time market coverage meets expert strategy.
From the opening bell to the closing bell, we've got you covered.
Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on our guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute.
With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live and on demand.
Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com.
2025 kept investors on their toes. Now, get ready for the road ahead. Join Schwab's panel of experts on December 11th for 2026 Market Outlook, your guide to the forces shaping stocks, global markets, inflation, rates, and more. Hear from experts on where the markets may be headed, spot opportunities, and see what could drive your portfolio next year. Tune in on December 11th at 7 p.m. Eastern on Schwab Network. I'm Steph Gladys, live from the New York Stock Exchange. When the market moves, we're on it. Getting the reaction, the strategy, and sentiment in real time. Stream Schwab Network at schwabnetwork.com.
My bad, y'all. I had to do a lot of phone calls. I gotta do one more. I gotta call. Make these tweets report.
Holding pattern ahead of the Fed's decision on interest rates. I'll give you a check of your scorecard as we hit the lunch hour. We've got a slim gain on the S&P 500. It is just above the flat line, better by
just shy of 0.1%. At top of the leaderboard, you got consumer discretionary, followed by industrials and financials. The Dow right now has a gain of just shy of 0.5%. NASDAQ 100 off by 0.2%. Russell 2000 higher by 0.4%. We could certainly start to see more shifts in the price action after 2 p.m. Eastern today. Here's the roadmap for today's show. We'll look at example option strategies for Oracle ahead of its earnings. Those are due after the bell today. Plus, the team from Lightfolio will be along with fresh sentiment data on Adobe. It's had a difficult year. And Synopsys has also got earnings due after the close. Now that we've got the roadmap for today's trading action, it is time to bring in my co-hosts and trading veterans. You got Tom White in our Chicago studio, and Kevin Higgs joining us live from the SIBO. As you know, we've got you covered from exchange to exchange and beyond. All right, guys, all eyes on the Fed today as investors anticipate another rate cut, but the road beyond that, a little more foggy, to borrow a phrase from the Fed chair himself. Tom, what's your take as we head into the decision?
Yeah, happy Fed Day, Diane Kev. I think, the market's uncertain right now, and that's why you've seen this chop so far this week. Is the Fed going to cut, which is widely expected, about a 90% chance that we're going to get that cut. But are they going to be hawkish or are they going to be dovish with their commentary? If you look at the data, the jobs data kind of reflected that maybe they should be a little bit more dovish and maybe they should continue with their rate cut cycle. But on the other hand, if you look at inflation, still above their targets, and that's a concern, I think, for the Fed. We're going to have to listen to the commentary from Fed Chair Powell and how he handles it. There's going to be dissenters, whether it's 1, 2, or 3 dissenters on a rate cut. We'll have to wait and see on that. But what type of rhetoric and consternation is going to be taking place within the meeting? Fed Chair Powell kind of pounded the table last meeting at the end of October that, hey, there were some tough decisions made and some tough rhetoric going back and forth between the Fed members. So that's what I think what everybody's eyes are on. The market's not comfortable right now. The price action, not good. And everybody's anticipating the Santa Claus rally. And then on top of that, you throw in the fact that long-term rates and the 10-year yield hit the highest level in 3 months. So that's causing a little bit of headwind here for equities as 3 major indices are in the red so far this week, just ever so slightly, while the Russell hitting fresh intraday high just yesterday. So lots to digest here, and we're going to have to wait and see and listen to the commentary.
Indeed, and then the question is, how much agreement or lack thereof could we potentially see? Kevin, what's your take?
This is one of the days for traders that it's a bit frustrating because you wait all day, and then you're gonna go from being slow to being real busy from 2 o'clock Eastern to the end of the day, and potentially beyond. I think what Jerome Powell says is more important than what he does. I think the dissenters are going to be interesting. I think the summary of economic projections is going to be incredibly important. And so I think this market, interesting though, price action. Tom mentioned the price action. Look at yields. Yields touched 4.2% and now are down almost 0.5%. So maybe that's a little look into the future. They were jittery going into this Fed meeting. They've been creeping higher. So has VIX been creeping higher. So I think this is going to get real interesting, Diane, around 2 p.m. Eastern. And then, because normally it would be 2:30, but we're going to get an SEP at 2 p.m. That's going to be real interesting as well. So, yeah, I think the busy part of the day is coming up, Diane, and it's about 2 hours away.
Yeah, indeed. But you know what else is interesting? GE Vernova, those shares powering up. And every time I look at this one, it just keeps rising higher after boosting its guidance all the way through 2028, doubling its dividend. The stock is now up 14%. I mean, you're seeing all these increases in price targets. Tom, what's your take?
Yeah, this news was coming out on Market on Close, and I'm talking to the producers. I'm like, hey, get this out there because this is big news on the maybe AI gas turbine, front. So these secondary markets that are kind of doing really well based on what's going on in AI and the data center build out and the energy needs that these companies are going to have. You mentioned stock hitting all-time highs today. They raised their 2028 revenue outlook. They raised that dividend double, up their share buyback by to $10 billion. And they forecast for 2026 revenues 41 to 42 billion. Free cash flow coming in at 4.5 to 5 billion. That was above expectations also. So everything going right. Free cash flow, up basically $1 billion from their earlier estimates. Yeah, this is a home run for this company. It kind of is reflective. If you look at the backlog, they expect that to continue to ramp up to about $200 billion over the next couple of years. So, yeah, backlog matters, and demand outweighing supply at this point for GE Vernova, and that's a benefit for these stocks. And I think that's maybe what investors have to start taking a look at. Who's going to benefit? Initially it was chip makers, right? It was NVIDIA. And some of the others that were implementing AI. Now you have to start taking a look at all these companies that are going to power the AI build out. And GE Verona, definitely a winner here.
Okay, I like that. I'm picking up what you're putting down, Tom, with the powering the AI trade. Kevin, what's your take when you look across this power player here?
When you think of the last 10 years in GE, and this was a company that they thought might be insolvent, because their debts were so big and the company was in such disarray. And when they split the company up into GE Aerospace, GE Healthcare, and GE Vernova was thought to be the weakest of the three links. Larry Culp split up these companies. He got them all healthy and then split them up. And everyone thought the other two would be the stronger. And look what's happened to GE Vernova. I mean, I've got a chart up. It's unbelievable. Last April of this year, it was $115. It's unbelievable. Or April of 24, it was $115. Now it's $700. It's nothing short of spectacular, and it's a tribute to the management of GE, Larry Culp, and the management team that got these three companies figured out and got them stable, and then split the company up and let these companies surge. And now GE Vernova, the energy part, right? Power, wind, electrification, they're right in the heat of this AI discussion, right in the middle of it. So, yeah, it's what a fascinating turn of events here.
It's a fascinating story, and you mentioned that $114 level, $115 around there. Yeah, JP Morgan Chase's new price target is $1,000 on this one, so we'll see where that lands come the end of next year. All right, this is what I thought when I saw this story. This is going to sound so cheesy, but oh my. I was like, what? According to the information, DeepSeek is using forbidden NVIDIA chips to build this next model. So we're talking about not the H200, but the newest, most advanced ones. Tom, what's your take on this?
Yeah, the company came out and basically stated that, it seems far-fetched that there's smuggling going on. Well, the company might be the last one to know on this front, because there's been speculation for the last year and a half, 2 years, that these shell companies over in Singapore are selling the higher-end chips to Chinese companies. I mean, it's probably, I'm not going to say it was easy for them to do, but it's probably taking place. If some company wants these high-end Blackwell chips, they're going to find a way to get it. And for NVIDIA to come out and say, hey, we don't see any signs that there's smuggling going on at this point, that seems a little bit naive to me at this point. It's a story. It's not founded by any stretch of the imagination, so you got to take that into context. The stock's down here a little bit. It's relatively flat on the week, but this is that fits and starts that's going on. If you look at their growth rate last quarter, over 60% for EPS and 60% higher than a year ago in revenue, and then you start taking a look at everybody trying to push back on this stock. Valuations aren't as high as they were. They're still right there in the mix, but for NVIDIA, it seems like even good news can't get this stock kick-started at this point, but it's just another story that maybe puts some headwinds into what they're trying to do. Justin Wong wants to expand to be able to sell these chips to China and other countries where the restrictions are in place. But until that happens, until we get some clarity on that. Maybe it's going to be fits and starts for NVIDIA at this point, but you can't kind of bash against the results that they've had over the past couple of years.
Yeah, and it looks like NVIDIA is taking a speed bump off of this report. And we haven't talked about DeepSeek since earlier this year. It felt like it moved to the back burner, but now this information report saying that there has been some smuggling of the Blackwell chips. These are not the ones that President Trump said could be shipped over there, obviously with certain parameters around it. Kevin, what's your take?
I think, people that don't believe that there's a black market, I think Iran sells oil on the black market. I think Russia sells oil on the black market. I think China buys NVIDIA chips on the black market. And I think if you don't think that's happening, you're a bit naive. And so the U.S. has got to do their best to police these markets as best they can and make sure China's not getting the most advanced chips. But to think that some of these aren't slipping through the cracks feels a bit naive, Diane. I'm relatively sure this is happening.
Okay, let's talk about another member of the Mag 7. You got Amazon higher today. Those shares moving a little bit higher. Instacart's moving lower. This is after Amazon announced it's expanding same-day grocery delivery to more than 2,000 cities and towns. So it's expanding its footprint here. And we've been having this conversation recently about how Amazon's competing against a variety of segments, and one of those being Instacart. Tom, what's your take?
Yeah, the story was kind of dropped yesterday a little bit on Instacart, and Amazon was going to expand their footprint. And I think if you take a look at it, I've been doing a lot of Christmas shopping on Amazon, and every time I put an order in, what pops up? Hey, continue shopping, and got all these, perishable items that come up right on your feed. So, yeah, this is going to hurt. And you look at the reaction not only from Instacart, but from Uber. And then also DoorDash. They're getting hit pretty good here today, based on the fact that Amazon's going to get into your business. They're going to disrupt it, and that's what they're doing now. This might be a better way for them to kind of monetize that noose around the neck with Amazon or with Whole Foods when they purchase that. They haven't really been able to monetize that probably as much as they want. But this is a game changer for some of these delivery companies. And logistically, Amazon, it seems like it would be a layup for them to get into this business and expand this portion of your business. As Kevin and I have always said about Amazon, you don't want them in your news feed saying that they're going to compete in an area where you're doing pretty well. So yeah, not surprising that we're seeing some weakness in these delivery stocks.
Like that for Instacart, it takes its gain year-to-date down to single digits because it was up double digits year-to-date. Amazon certainly needed some kind of win because we've talked to analysts after analysts who said, okay, they're going to finally catch up in terms of the Mag 7. We've been waiting all year for that. They haven't really caught up yet, but maybe this is a potential tailwind. Kevin, what's your take?
If you watch the show a lot, you've heard me say this before. If you have high margins, or if you are a middleman, Amazon will attack your business eventually. They're coming for you. And this is just, remember, Instacart's just the middleman, taking groceries, delivering them to other people. And that's a prime candidate to be attacked by Amazon. It's why Amazon's getting into healthcare. It's why Amazon's getting into all these businesses. They have the infrastructure and technology to streamline these businesses and make them more efficient. Not really surprising. If it's a middleman or if it's a high-margin business, expect Amazon to get there eventually, Diane.
Okay, all right. We'll be on the watch for that share. Amazon moving higher by more than 1% today off the back of this development. Coming up, we've got bull versus bear. The guys get their example trades put together for Oracle. It's got its earnings due after the bell today. We'll have more fast market on the other side of this break.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Sometimes, you know, you could have done better. Same goes for where you invest. Level up and invest smarter with Schwab.
Welcome back to Fast Market here on Schwab Network. Oracle is on deck to release its quarterly report card after the close of trading today. Here's where expectations stand. Analysts are projecting earnings of $1.63 per share on revenue of just over $16 billion. The big question will be, how well can it service its debt on its balance sheet, and what does CapEx look like? Oracle's considered levered in AI, and concerns around that have been a headwind since its last earnings report. But the stock is still up year to date and outperforming the broader market. Time now for the bull-bear tug of war. Today we want to welcome back in our co-hosts Tom White and Kevin Hayes. It is bull versus bear time. Before we get to the exam trade, gotta talk your take on Oracle. Kevin, I'll start with you. You heard kind of the setup going into this. If you looked at it on a one-year basis and just looked at the percent base, it looks great, but that doesn't tell the full tale of the tape. What's your take?
Yeah, since September 10th, this stock has gone from $345 down to $200, and now it's drifted up to $220 ahead of earnings. The last earnings report, you see the massive move that this had. Expectations are relatively low because the stock is sold off. I think that this is going to be another really interesting earnings release for Oracle. Do I know which way it's going? I have no idea, Diane, but I think it'll probably move the expected move over $20. So that's just under or right around 10% move. That's big for a $200 stock. So I think everything that they have going on, their key role in AI and cloud, they're kind of a hybrid AI cloud. I don't know if that gives them more of a valuation or less, but boy, they have a lot going on, and they tend to win some of the things that they're involved in. So I think this is a massive earnings release. It'll be probably the biggest of the month here, Diane.
Okay, Tom, what's your take heading into this?
The increasing use of debt to fund the capital spending in the AI race has shaken investors. The price action on Oracle over the past month and a half, since Kevin mentioned those highs that we saw about $345 in September, it's just been dismal. And that's, a concern for investors because the valuations are still high. Remember, 2 years ago, this stock was $80. So we're still at $220 at these levels. So it's had a great run, but it's pulled back 36% from those all-time highs in September. And that's a concern for investors. When you're taking on debt, they just, financed $18 billion. Citigroup came out with a note. They said they might need another $20 to $30 billion to continue to build out these data centers that they're reliant on at this point. Remember, their remaining performance obligations up to $455 billion, and that was on the back of a $300 billion investment from OpenAI, or that partnership with OpenAI. Does that even come to fruition? And that's what the questioning is going on from investors is this actually going to happen? Because is OpenAI going to be able to finance all these projects that they have and these partnerships that they have within the data center build out to enhance AI? And I think that's a real concern here for investors. Kevin mentioned implied volatility levels really elevated going into this report. Over a 10% move either way in the stock going into the report is reflective that investors are uncertain here, even with this massive bear market, pullback that we've seen from those all-time highs. Stock's still up pretty significantly over the last 2 years, and And there's going to probably be some movement, whether it's from the Fed or whether it's from Oracle earnings for the overall market.
And Oracle, I'm sure, would like to see that cut from the Fed today and more to come, especially given the situation with debt there. All right, let's get into the example trades. Kevin, let's start with yours.
So the example trade that I'm looking at here is taking advantage of two things. An expected 10% move, $21.90. It's currently, it'll just downtick to $21.60. But the front month implied volatility, the front expression, 169, the second 95. So a big dispersion between those two numbers. So, do I know where Oracle's going? I don't, Diane and Tom. And I think the trade that I put up here, the paper money trade, shows that. I looked at something in the double calendar family, which means I calculated the expected move just over $20. And then I did the 1 week $245 call calendar and the 1 week $200 put calendar. So I've got a move of about $45 if you move the strikes. But you're looking for a move, and you're looking for a move towards one of these strikes. Now, the last time it moved way past these strikes, so you've got to be careful there. If you think it can go further than $20, this might not be the right trade. You know, it collects a lot of theoretical theta because you're selling that front month expiration. And Tom, I think I'm pretty clear. I have no idea where this stock is going.
I love that, Kev. It's the need to move strategy. You want to move about that one standard deviation. This strategy allows you to not have to pick a direction, right? You could be, right on either side. If the stock goes up or down, you just want to go about that one standard deviation. But let's break Kevin's trade down. December 19th monthly options that expire in 9 days. Buying the 245 call, buying the 200 put. And then in the near term, December 12th weekly options that expire in just 2 days. Sell those same strikes. Sell the 245 call, sell 200 strike put. Double calendar position, 1 week wide. On this, you're paying roughly about a 245 debit. There's your risk, $245 per spread. But you can see there from the risk profile, the apex of profitability is either at or near 200 or at or near 245 on this one. So you can go either way. You just don't want any big 2 or 3 standard deviation moves either to the upside or downside. Your break evens on this one, roughly about 185 maybe on the downside and maybe about 260 on the upside where you can still be potentially profitable. The 3 things you don't want to happen in this type of strategy. You don't want the stock to kind of consolidate here at or near 220, or you don't want that big massive $40, $50 move to the upside, or that $40 or $50 move to the downside, or even more, because that just start getting away from potential profitability on that one. Kevin mentioned it's 245 debit on this. It covers, it gives you exposure to the upside or downside. So this is your bull bear debate right here. You just don't want an outsized move. And Kevin mentioned that vol dispersion. That's what lowers the entry point price on this double calendar position. But you still have risk in it, $245 per spread on that position. So that's taking advantage of that vol dispersion. Kev, I'm going to flip it though. And this is a strategy that you can use. My example is going to be bullish. You can use it for a bearish type of stance also if you flipped it and did the puts. But we're going to look at a call diagonal here, just 1 week wide. We're going to use the same option series that Kevin did. We're going to go out to the December 19th monthly options here. Buy the 220 strike calls, basically at the money. And then go up about that one standard deviation, which is just about 20 bucks. Sell the near-term December 12th weekly 240 strike call. So a bullish $20 wide call diagonal. You're paying roughly, we got $8.50 debit on it. It's probably trading closer to $8.20. A little bit cheaper because the stock's moved down a little bit. But the debit you pay is going to be your risk. $850 per spread on this. Anything above that 225 level is going to be potential profitability on this one. So this is more aggressively directional. both trades could actually profit if the stock goes up near 240 on this type of positioning, if you kind of think about it. But that vol dispersion lowers the entry point price. So, Kev, this is a $20 wide call diagonal. I'm paying less than $8.50 for this thing.
Yeah, you know, this is a better trade if you think it could move further than the expected move to the upside, right? Because this wouldn't go up and then come all the way back down, because my trade pinpoints that 245 strike. If your stock, if it goes to 260 or 280, your trade stays profitable on the upside. The trade-off is you pay more for it, right? But there's depending on your opinion, this sets up a trade for everyone's opinion on this trade. It's a diagonal. It's basically the same as a calendar spread with just the embedded vertical spread in there. So yeah, a bunch of good ideas for whatever you're thinking about Oracle, Diane.
Yep, and if you think about this, Diane, I said this is the bullish call diagonal example. If you're more bearish, you could buy the 220 strike put in December 19th and then sell the December 12th weekly 200 strike put. That would give you exposure to the downside, probably going to cost you roughly the same amount. But what lowers the entry point price on this directionally bullish trade that we've got up here is the fact that that vol dispersion, what you're buying in the longer term options versus what you're selling as far as implied volatility levels. But bull bear debate from Kevin and a bull debate from me on this one.
Choose your own adventure. I like it. And then Tom, also, I find is interesting is leading up to your example trade, one would think you may take the bearish take, but there you have it. You never know what we're going to bring you. We got cash tags coming up. The team from Lightfolio will be along with new data on Adobe. That stock's been a major underperformer year to date. Keep it right here on Schwab Network. Fast Market will be back after this break.
Hi, I'm Alex.
I'm Jane. And I'm his mom.
Sometimes, you could have done better. Same goes for where you invest. Level up and invest smart with Schwab.
I'm Sam Linus, live from the New York Stock Exchange. When the market moves, we're on it. Getting the reaction, the strategy, and sentiment in real time. Stream Schwab Network at schwabnetwork.com.
Trading at Schwab is powered by Ameritrade, giving you even more specialized trading support. Connect with the Schwab Trade Desk, our team of passionate traders ready to tackle your trading questions, no matter how complex. Plus, get 24/7 live help and access support by phone, email, and in-platform chat. Trade brilliantly with Schwab.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. Are you an active trader? Our active trading webcasts are designed to help you develop a deeper understanding of technical analysis, options, futures, and more. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
No politics, no spam. Just the market from open to close and beyond. Streaming 24/7, any screen, anywhere at schwabnetwork.com. We're back to that market here on Schwab Network. I'm Diane King, all alongside Tom White in our Chicago studios. Time now for our cash tag segment. Today we want to bring in our next guest, and that is Landon Swan, co-founder of Lightfolio. Taking a look at Adobe today, and for me the question is there a spark from Firefly? Because listen, shares have underperformed year to date. If you look at it on a year-over-year basis, it's even worse. Landon, what's your take based on your data?
Yeah, this has been a pretty rough year. I mean, you look at a year ago, the stock was trading at $5.50 because
it's about 344 right now. So yeah, tough times for Adobe investors. And actually, you look at earnings, they have traded down on 7 out of the last 8 earnings reports, including the last 5. Now, the last report, they had a little bit of a pop-up. It ended up down on the day, sold off. Revenue was up 11%. AI revenue passed $5 billion. AI-influenced revenue passed $5 billion. So a pretty good report. But I think that a lot of people are just concerned that maybe it doesn't stick, or maybe there's a lot of competition within AI. And really, when you think about what they're producing, all of the tools that they have, if you didn't infuse AI into all of Adobe's products, then they're going to get beat out by some competition. So they have to go into the AI. They're doing a great job of it. And you mentioned Firefly, that's leading the way. I mean, you look at how many times Firefly has been used. I think it's up to 29 billion now. You can create images, video, audio, any kind of digital assets. And this is a good chart. It's not great. It's not ramping up exponentially as you'd like to see it. You can kind of tell that it is increasing at the rate of increased rate is going up, but it's not really exponential. It's not growing extremely fast. That looks different than like a GPT chart, for example. However, they are doing a good job of integrating AI and making all of their products better. They've got it into Photoshop, they've got it into Illustrator, Express, even PDF Reader Acrobat is using it. They've even opened up an LLM optimizer so you can get your website viewed more as a recommendation when people start searching with LLM instead of Google search. So they're doing a good job of integrating it, and everything that we see is showing that it's starting to pay off. Users are really using it more. Last quarter, their consumption was up 32%. The custom models up 68%. So really getting a strong move in the right direction. I think people are concerned with 2 things. One is competition. Google Gemini is doing great, and anybody can create new products that are similar to Photoshop now, which used to be their bread and butter and their separator. But now with AI, a lot of things can do the job that Photoshop can do. So they have to continually stay on top of that. So competition, and then the other thing is compute costs. These queries run by users are expensive. Obviously they have to do it. Adobe has to offer this in order to stay competitive, but it's going to be expensive to service these clients. And so what are the margins going to look like? I think those are the questions that people want to see. Is the adoption continuing to increase? Is the rate of increase continuing to increase? That's really important. What do the costs look like, and what's the competition landscape out there? Now, just looking at the stock, seeing how much it's off, I think it's off like 37% from a year ago, maybe 22% year to date. So really, poor performer. And like I said, it's been trading down on nearly every earnings report in the last 2 years. So, it could be sort of primed for that. Bleeding has stopped, and we're turning the corner with AI. I think that's what investors want to hear. So we'll see if that's what comes out today. But just based on the data, we're seeing quite a bit of a divergence between the demand from the consumer and the reaction or the expectations from the investor. And so right now we've got demand at plus 7% on a year-over-year basis, which doesn't sound great, but it is positive where it's been negative for a long time. And the stock, like I said, is down about 22% year to date. So that divergence is starting to get our attention. The stock is looking a little bit cheap right now, and we're starting to lean to the bullish side going into this earnings report.
Landon, I'm going to read off some of their competitors in this space. They've got different ones, right? They've got different silos of revenue generation. Microsoft, Google, Amazon, Salesforce, Oracle, Canva, Autodesk. That's not good. That's not good on any stretch of the imagination, because a lot of companies have, subscriptions with these existing companies. You mentioned, these image generating, AI chatbots that are, killing them at this point. And valuations are probably normalized now. Forward PE on this is about 15. And I remember when this stock was trading 4 years ago, it was trading $699. We got 50% from those levels. I see that your data is reflective that you've got good metrics as far as, the consumer in your data shows, but at the same time, the competitive pressures have really hurt the stock, and maybe it should have, right?
Absolutely. I mean, this, it's kind of like if your son or daughter was thinking about going into graphic design as a major, you might shy them away from that. Say, hey, you know what? A lot of people can do those things now with just a tool because it's so powerful. You don't have to spend hours and hours learning Photoshop. You can just tells something about what you want it to build, and it builds it. By the same reason, I think a lot of people are saying, well, why would I invest in Photoshop, Adobe, and even with Firefly and all the other products that they have, when a lot of other people can build things like Canvas is relatively new, right? Now they're taking a lot of market share, for example. So it is, I think competition is the biggest thing now. The other side of that token is they've got the user base, right? So they have a ton of people that have used Photoshop for a long time, that have used Illustrator, Express, and all of these different tools for a long time, and now they're way more powerful, and they're as good or getting as good as a lot of competition, and they're familiar with those products. So I think that's the edge, right? If this was a startup, they're trying to raise money, I don't think they would get a sniff. I think that everyone would say, well, why would anyone use you versus someone else? But they've got this massive user base that's used to their products, and now their products are catching up. All their friends and naysayers saying, why are you still on Photoshop? You can just plug it into one of these image generators, and it's better. But now Photoshop is catching up as good or better as the competition. So those hardcore fans of Adobe can say, you know what, I'll stick with it because they're continuing to improve. They're pouring so much money into AI. It's getting better. My experience is getting better. I think that's the bull case. And the bear case is the list of competition you just listed off. And is it going to be tough to acquire new customers? Yeah, holding on to some older customers maybe, but getting new customers is going to be tough. I think their margins are going to get squeezed.
So, Landon, I'm gonna, when you look at the stock, obviously, you can't ignore the performance, so I think, I hear what you're saying, especially about the competitive landscape. I think that makes sense. You have to pay attention to the free options. But I don't think they're as good as, quality design, right? When you use some of these free options, you got an extra finger, an extra hand, whatever, that shouldn't be there. And so when you're
because Events America told me to get one for y'all, so that's why I'm calling.
It's not what you want, so you end up hiring someone to do that for you. So I still think there's a place for that. But I'm curious to know, is this about a timeline for Adobe? In other words, weak performance for a little while longer, or starting to turn a corner after they figure out how to stay competitive. What's your thought based on the data that you see?
I think that's what investors need to hear, is we figured it out. AI usage is ramping, we're holding onto accounts, we're signing new accounts. Our stuff is just as good as everyone else's, and they're willing to pay for it. It's better in some cases. I think that's what investors need to hear, because the fear of competition, I think, is very, very scary. There's so many names, so many big names, and we've all seen, if you go back a year, what AI can do versus now, image generation, video generation, it's laughable. I mean, the increase over that last year has been unbelievable, so they have to incorporate it. They are incorporating it. They're doing a good job. And remember, before AI, they had the best tools, right? I mean, Photoshop was hands down the best image editor in the world before AI came out. And so now they're adding AI to it, so it should get back to that #1 spot as long as they do a great job. And I think the usage of Firefly is making the case that it is getting back to that #1 spot. And so you can see here on the chart, the blue line is the consumer demand, that dotted line is the stock price. That's the kind of divergence we're looking for when we make a bullish call. So this is telling us that there's a chance that they come out and put up some numbers that put the fears of the investors to rest, and say, you know what, we figured AI out, we've got the greatest platform, we've got the greatest tools and services, but people are still willing to pay for them, and we understand how we're going to be competitive and move forward in this new environment. This has been a huge monkey wrench into the system of a great set of software tools that have just been the kings for a long time. Now AI is just disrupting it like crazy, but it looks like Adobe's making the right calls, and I think that they have a chance to say, hey, bleeding stop, we're turning a corner, and the future is bright. And then, all of a sudden, 340 looks like a cheap stock price listing. So, I don't know if I want to hold this long term, but I think on a risk-reward level, I think it's definitely worth a bet to the upside on this particular earnings report. I think it's more likely up than down, and I'd be willing to bet on it.
Okay, interesting. All right. Wasn't expecting that in there. That's Landon Swan, co-founder of Lightfolio. Thank you, Landon. Now, for the trading perspective on all things Adobe, let's bring Kevin back in the conversation. Tom, he brought a lot of stuff, and so like I said, I didn't expect him to end where he landed on Adobe. What's your thought before you guys get to the example trade?
Yeah, the bar's low on this one. And, if you look at their data, especially that last chart that showed the stock price versus some of their data, and the divergence that you've seen, pretty spectacular. If you look at the segments within their industry, digital media is supposed to grow about 8%. Digital experience supposed to grow over 10%. Subscription revenue, that's supposed to grow 10% year over year. So they're still growing, and the valuation is really low. Kevin, you look at this one, the option rate, it's a $343 stock. It's still pricey on a dollar basis. The option market's pricing in about a plus or minus $23.5 move in the stock post earnings. How do you want to look at this one from an example trade?
Yeah, my view on this, you guys have made several different arguments. My argument will be the PE argument. This stock spent most of the early 2000s between 50 and 60 PE. The lows was 33 PE. Now it's in the low 20s in terms of PE. So this has turned into a value play, Tom. So I looked at the expected move, right, about $23, and just looked at something around the $365 strike. And so I did, again, the 1 week call calendar, only spending $1.50, actually even less than that now, for a 1 week calendar where, if you're correct, this could be a multiple winner, Tom, if it moves up towards $365. So an inexpensive call calendar if you want to play the upside. The risk is that it goes through that 360 strike and much higher.
Yeah, let me break this one down here for you, Kev. 1 week wide call calendar. So this is kind of taken off your double calendar position that we looked at in Oracle, but just using one side, kind of setting up with what Lightfolio gave us as far as their data. But it gives you upside exposure for not a ton of risk here to the upside. So going out to the December 19th, monthly options that expire 9 days, buy the 365 call, sell that same 365 call in the December 12th weekly options that expire in 2 days. Paying roughly about, we've got a $1.50 debit on here, probably get it for about $1.30 at this point. But the debit you pay is going to be your risk. So if you pay about $150 per risk, that's not a lot for that upside exposure. Now your break evens on this, you can see here from the risk profile, you want it to go at or near 365, which is about that 1 standard deviation. But you probably got a range between maybe 350, 355 on the downside, maybe 385, 390 on the upside, and you can still be potentially profitable on this one. And goes back to that vol dispersion that we talked about on this on these type of trades, Kevin, where you're buying a low implied volatility in the December 19th monthly options, about 65% implied volatility on aggregate in that series, selling about 116% implied volatility in the near-term options, so that vol dispersion lowers the entry point price. What you don't want to happen on this, you don't want the stock to fall, you don't want the stock to go up maybe 2 or 3 standard deviations. If it goes up $40, $50, $60 to the upside, it pops. That's when you start losing potential profitability, and you've got risk to the upside also. But sets up with Lightfolio's data here, Diane, and taking advantage of those vol levels in Adobe.
All right, guys, good stuff. We've got the breakdown coming up. We'll be taking a look at Synopsys ahead of its results. Oracle's not the only one, but the results are due after the bell. Right back.
I don't know. I've never seen it. I don't know. I just see it. My mom from Atlanta knows I have my kids for 7 straight years, so I just feel like this edition, there was great. I'm here talking to the clothes. Right? I just feel like it was the best. I mean, so all I say is, I didn't know this person was on anything. I'm not even trying to I don't even know what to do. I'm just trying to get
Stay connected to the markets, the Schwab Network.
Tune in 24 hours a day, 7 days a week on schwabnetwork.com
and on all your favorite streaming services. Schwab Network, available anytime, anywhere, on any device for free.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Welcome back to Fast Market here on Schwab Network. I'm Diane King Hall, live on the floor of the big board. Before we get to the breakdown, let me give you a check on where markets stand as we get closer to the bottom of this hour. We've got the S&P 500 hugging the flat line, up by less than 1/10%. The Dow's got a gain of about 1/3%. NASDAQ 100 softer by 1/4%. Russell 2000 has a gain a little bit more than 1/10%. Again, investors seem to be in largely a holding pattern ahead of the Fed's decision on interest rates. Synopsys is set to report its quarterly results after the closing bell today. Wall Street is expecting the company to log revenue of $2.25 billion. Now, you remember, NVIDIA recently announced an investment in Synopsys and gave it a lift, increasing 12% this month. The stock's still an underperformer year to date. Time now for the breakdown. Joining us for that, we've got George Silla, senior markets correspondent, for the fundamental look at Synopsys. So, George, is the bar higher now going into Synopsys results today?
Well, that's a good question. I think, it's an interesting situation for this company, which is actually the largest semiconductor design solutions firm. They do compete with Cadence Designs and Siemens out of Europe. So, for what it's worth, it's an interesting situation, like I said, because the stock is actually down about 7% over the last year. It's underperforming its competitor Cadence, and I did notice too, if you look at the EPS numbers that you listed, they're expected to be down about 15% compared to the same quarter last year, when the company earned about $3.40. But sales are expected to be 37% higher. So I suggest that there seems to be maybe some internal operational efficiency issues that the company's been going through. In fact, if you look at some of the news reports for Synopsys as of late, they are cutting back some of their workforce, as well as shutting down some unprofitable areas of their capital expenditure. So it seems to be firming up their profitability, but the top line sales have actually been increasing, and they are expected to continue to increase. For next fiscal year, they're anticipating over $9.63 billion versus this year. They're expecting only $7 billion for the full year on a sequential basis if you take the summation of the last 4 quarters, including the one they're about to report. I think this is an interesting case where this is either a good opportunity, sort of a mispricing of the stock relative to competition, or maybe a situation where there's an accurate pricing going on with the firm. If you look at their business in networking and high bandwidth memory, as well as other headline aspects of chip design. Look at Google, look at Broadcom. These are 2 major players in the chip design space, the semiconductor space. And so, Synopsys is one of these companies that is partnering with these major semiconductor design companies. And again, the partnership with NVIDIA is quite promising for the business. But nonetheless, we may be in a situation where estimates for the quarter, which are again supposed to be down compared to last year, are maybe fully expected. In other words, the expectation for a drop in earnings is already priced into the stock, considering the stock is also still down about 7% over last year.
So it's interesting, because I wonder, where you take it from here, and obviously guidance will be important. For instance, yesterday you had analyst Rosenblatt, and to me they kind of, are playing both sides of the fence. They upgraded Synopsys to a buy, but they lowered their price target. Still higher, obviously, than where it is. I shouldn't say obviously, it's 560. So they see some, potential momentum from here. What's your final thoughts on this one, George?
Well, it could be, and this is why I say it's kind of a tricky one, because if you look at the sales numbers, they're actually quite good. So when you have sales numbers, in case you point here, about 37% compared to last year, I did a comparison of the
fiscal year we're in for the business compared to next year, they're still expecting high 30% sales growth. With earnings growth going in between the 2 years only 9%. So to me that suggests at the very least that there is some operational changes going on. It could be technology changes, it could be high CapEx needs, which again may be priced in. And that's why I think some of these analysts are still constructively bullish, irrespective of the price action that we've seen, especially in the last couple of quarters, or at the very least since July. So again, that's where it's tricky, because I think this could be a possibility where it's really underappreciated and it's burned to the price it should be.
Sorry about that, y'all. I had a bunch of calls this morning.
One could question why those EPS numbers
Gotta
are not very
settle
good
this
compared to
loan with the
sales
loan
growth
company and
numbers.
all that.
Again,
Get that
it could be
information in.
accounting issues, it could be a vast array of different variables you have to consider, but nonetheless, if there's an increase in guidance for EPS alongside some similar guidance for revenues, we may end up seeing a nice trend reversal in the same.
All right, interesting. I mean, one to watch is not just about Oracle.
They hear fast as hell.
Thank you, George. That's George Sillis, our senior markets correspondent. Let's get Tom and Kevin back in here for example trade purposes. So, Tom, you got the example trade this time in Synopsys. What's the approach?
Yeah, you take a look at a 1 year chart here in Synopsys. It's been volatile to say the least on this one. Remember last quarter, they said Q3 was impacted by IT underperformance challenges at a major foundry. That caused the stock to dump pretty significantly. It was trading above $600 and it settled the next day after earnings around $387. They've gotten good news recently on the $2 billion investment from NVIDIA. The strategic partnership that they're formed with NVIDIA, that's been a bonus. We've seen a couple upgrades recently, so we've seen that uptick over the last month or so, bottomed out around $380 a share. But the option market pricing in a hefty $38.50 move either way in this one. Kev, I looked at something where I don't want to be a hero in a stock that's, trading $468. You don't trade this, it's not like a heavily traded name. IV percentile rank though up there about 63% right now. So it's in the top 2/3 as far as implied volatility levels going into this report. So kept it not simple, but not basic, but just pretty straightforward, where I give myself a cushion and I can profit in 3 out of 4 scenarios on this short put vertical December 12th weekly options cap. So just 2 days to expiration earnings type example here. Sell the 3 or the 430 strike put out of the money to the downside, and then against it buy the 420 strike put. Basically a $10 wide short neutral to bullish put vertical. It was trading 250 earlier. It's trading closer to 205, 210 right now. But price discovery warranted on this because we've got some wide bid-ask spreads on the individual options. But Kevin, this is, you collect 250. You got $750 in risk, but it takes your break even down $427.50 if you can collect 250 credit. But not keeping it simple, but being a little bit more cautious, conservative, and passive on this bullish trade.
77% probability of finishing out of the money on the 430 put. You don't have a lot of time, just basically 2 days of trading in this name. So selling a $10 wide put vertical, your max profit is the credit taken in. The risk is the difference between $10 and whatever credit you took in, Tom. So high probability about 77.25%.
77.25%, and that's one of those things we always talk about, Kev, is if you're more aggressive, where, hey, maybe I sell the 450 strike put, you've only got a 63% probability of finishing out of the money. That $10 wide 450, 440 put vertical, you can collect $3, but at the same time, it lowers your risk, it gives you more of a credit, right? But at the same time, the probabilities are less on that type of trade. So those are those trade-offs that you got to talk about on trades like this. But neutral to bullish here, Diane, and Synopsys, with the expectations that, hey, maybe it goes down, but I can still profit if it stays above 427.50.
All right, thank you guys for the breakdown there. And that's going to do it for us today on the Fast Market. I'm Diane King Hall alongside Kevin Higgs and Tom White. Download the Schwab Network apps in the App Store. Tune in 24/7 on SchwabNetwork.com. Stick around. We've got Next Gen Investing coming up.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of the platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
Welcome to Schwab Network, where real-time market coverage meets expert strategy. From the opening bell to the closing bell, we've got you covered. Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, but not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas minute by minute. With shows built for action, we break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way here going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, veteran traders, and trusted financial journalists. Streaming live. Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com. 2025 kept investors on their toes. Now, get ready for the road ahead. Join Schwab's panel of experts on December 11th for 2026 Market Outlook, your guide to the forces shaping stocks, global markets, inflation, rates, and more. Hear from experts on where the markets may be headed, spot opportunities, and see what could drive your portfolio next year. Tune in on December 11th at 7 p.m. Eastern on Schwab Network. I'm Nicole Pedalides at the New York Stock Exchange. Live interviews, market movers, and real-time coverage right from the floor. Subscribe now at SchwabNetwork.com.
I couldn't even read until I get a phone because I couldn't access no computer because of the two-step verification. So while they're kicking me out, I had to buy a phone. My phone was my phone. This is the phone I'm on. I don't use it. I'm not the number on the phone. And I was coming together.
Welcome to Next Gen Investing, and before Happy Sunday, I'm joining Ward alongside Alice Coffey. And Alice,
I forgot. I was like, what holiday is it?
I was thinking after I saw it, I was like, wait, no, it is Wednesday. It is Sunday, yes. We have, of course, some updates from the Fed coming in just about an hour here, but markets, as they typically are, feel like they're holding their breath a bit as we do wait for the major catalyst this week, and also then later today is when we get a slew of some bigger tech earnings after the close. So it does feel like today is really what ramps up some of the market activity for the week.
Yeah, more of the same though. I mean, I'm not putting a bunch of stock into any of the last three sessions just because so much of this week is going to be determined in the next couple of hours. But you're starting to see that dynamic where there's a rotation out of the NASDAQ into the Russell 2000 on balance. And to me, alongside kind of the bounce back you've seen in crypto, it isn't a deleveraging or de-risking out of these AI stocks. It's just a changing of the risk. So it's truly rotation that we're seeing, and it's going to some of these more interest rate sensitive areas of the market, which does make sense with one of the big catalysts being the FOMC and the potential rate cut that we're going to see. But, you know, like we often say,
especially now. This next hour, I'm putting almost no stock into anything that the market does. I wouldn't be surprised if we are back towards unchanged in the next hour. But I ultimately don't think it's going to be the determinant of how today goes. I think that's a controversial thing to say. When we get the announcement and they redline that statement, and there's the dissenters or there's not dissenters at the top of the hour, about 59 minutes from now, there will be a reaction. And then ultimately, Jerome Powell will take the stage, and they will shift the narrative to whatever they want it to be, and the market will have another reaction or five, and, in 3 hours from now, we're going to be talking about a very different story. Even if we're still trading 8 points higher or whatever we are right now, that will have been the story of the day. It won't just be an unchanged market to the close. There will be movement. It'll move around. We'll react to things, and there'll be a story that's written, but you can't write it until we get Jerome Powell's words.
Okay, and I do completely agree. Not to say some of these individual equity moves don't necessarily matter, but I do think good to keep your finger on the pulse of these markets as things do trade perhaps quite differently in about an hour, I think, and more so an hour and a half once we hear more commentary from Jerome Powell himself. And so we have a lot to look forward to over the next several hours. A lot of time left, of course, in today's trading session, but as always, we'll kick things off with some of these movers to keep on your radar. We will also then be charting and trading CoreWeave as well as Beginning Computing, which both names seeing some significant pressure today and both operating in the generative AI world. We'll also discuss the move today to the upside, a phenomenal move to the upside today in GE Vernova, which made new highs. We're up now 13.5% on some raised guidance. We'll also discuss the latest from Palantir. They did secure some major contracts with now the U.S. Navy worth almost $500 million. And last but not least, we'll close out the show with a more labor focus as we do preview some of the expectations for the Fed. Of course, then we'll be just minutes away from getting that key announcement from the FOMC.
Yeah, I'm excited for just getting through this, right? Like, it feels like we're really buttoning up things for the end of the year. It seems like getting through this Federal Reserve meeting is going to be key to start to do that. It'll really set the stage, I think, for what next year potentially starts to look like. But we still got to get through this next hour and go through some of these. Let's go to some of these earnings movers, because I was looking at this group and I was thinking, wow, this is a motley crew of names. Like, we were getting to that thin part of earnings. I know we got some fun ones with names like Broadcom still left on the calendar, but we're talking Chewy, GameStop, and Cracker Barrel. Now let's talk Chewy, because you know how I feel about this company. I think they did a lot of things that Amazon's done well, and they took it, put it on steroids really with the marketing, the packaging, and really leaning into being better in servicing, pet owners than Amazon does. Because if it's just about price, Amazon's very, very hard to compete with. But when it's about customer experience and expertise, which I think Chewy really lean into, in this specialty of pet supplying and pharmacy, they do a good job.
They do a great job, and they're also great at reminding you when it's your pet's birthday, which I just never remember.
The handwritten note.
The handwritten note. I have to give them
20 million some customers, and they're doing that. That's pretty incredible.
Whoever's in charge of that, give them a raise, because it's like my favorite
auto pen.
I do always wonder like how much of that is handwritten, but hey, it's an amazing thing. It does definitely keep your customers very loyal. But looking at their higher third quarter profit and revenue, they did give a more bleak outlook for the fourth quarter. So profit was, 14 cents a share, or roughly $59 million. That was, an improvement from last year versus like 1 cent per share. But adjusted earnings also did come in slightly ahead of estimates, while revenue rose about 8%. Also slightly beating forecasts. These were modest beats at that, but they did add roughly 250,000 net active customers on a sequential basis, bringing now their total customer base to just around 21 million. Now, net sales per active customers rose about 5% to 595. That did miss estimates by about $2 and some change. And the CEO did say that they continue to outperform the broader pet care sector, as well as expand their market share. But guidance, we saw that for the fourth quarter, adjusted earnings per share at the midpoint was a slight miss. Net sales at the midpoint was also a slight miss, but again, not a huge miss by any means, because, like, for example, net sales were guided to be between 3.24 and 3.26 billion,
the expectation was for 3.26 billion. So this was modestly, we're talking pairs of disappointment. And for the year, they did also give now a slight revise actually to the upside sales forecast of 12.58 to 12.6 billion, just narrowing the range they had previously given. So I don't think guidance would necessarily imply that anything is weakening per se, but not growing at the same clip that perhaps the street has become accustomed to.
Yeah, I think it's in a transitionary phase, right? Like when using a very different business, but has made a similar transition, and ultimately, if you do it right, the market will still reward it. Is Netflix? Netflix went from a very growth-centric company that wasn't making any money, but always had the potential to make a lot of money because it was delivering a service and had the different things that it could leverage the pull, like the password sharing crackdown, adding ads. But then it becomes less about growth as your market becomes more saturated and more about generating cash flow and returning earnings to shareholders. We might be watching that slowly happen for a company like Chewy that has tremendous amount of adoption, no pun intended, of the platform when there was a ton of pet adoption during the COVID time. But that kind of pull forward demand, right? It's not going to happen that way every time. And so what we start to see now is they slowly built that auto ship network. They're slowly but surely growing the sales per active customer. But that active customer metric is pretty anemic in terms of growth. It's only grown about 2.5% in 2025. And so when you are less than about 2% in 2025. So when you start looking at it that way, yeah, it's not going down anymore, but it's much more stable. So now it's more about, can you consistently either grow the amount of money that each one of your customers is spending, or at least maintain it, and then it becomes much more of a, kind of an income-driven or cash flow-driven investment than a growth one. So fascinating transition. We'll see if it can continue. Speaking of transition, let's talk GameStop, because I don't know what iteration of the transition we're in, but this is a company that really saw its core traditional business model just disrupted it. And it's safe to say it's nothing against GameStop, but the times of going to the store to buy a video game, that's in the past, probably about a decade now.
Yeah, and you see that really reflected in some of their individual components of this disappointment. I mean, like with other companies, really, unfortunately failed to stage a pretty significant turnaround as the traditional aspect of its retail business continues to face some pretty major structural challenges, even as their profitability and cash position have improved. So their massive cash position likely has something to do with some of the, hopefully, I'd say, improvement as far as the overall story versus a year ago. Their cash and cash equivalents and marketable securities did stand at roughly $8.8 billion. That was more than double the $4.6 billion reported in the same period a year ago. Now, long-term debt did stand at around $4.2 billion. But the substantial cash position might explain why we haven't seen it take the route of some of the year's most recent meme stock moves, and why some of the underlying nature of the retail business just frankly isn't healthy. I mean, we saw software sales contract 27%. We saw hardware and accessories contract another 12% year over year. Now, collectibles were a huge bright spot of 50%, but facing also easier comparisons than what we saw a year ago. So, and we also know that they have a pretty substantial holding now in Bitcoin, although I was reading one analyst's estimate of this where they see it only impacting GameStop at this point, given, its current business performance and some of the conversions around Bitcoin, that although a $10,000 change even in Bitcoin's price, they estimate only does affect the value of GameStop by roughly 10 to 11 cents per share for taxes, which actually is quite substantial, but it goes to show that they do still have this sizable exposure to Bitcoin, trying to be like a strategy, but just not resonating the same way with the street.
Yeah, in many ways, the meme stock nature and where GameStop found itself as a result of that was like a life raft for this company. It gave them a tremendous inflow of capital. Now, ultimately, what they're able to do with that is whether or not they just build a higher floor for the company.
I'm trying to hear all that with the police. I had to talk to the police, and then the neighbor wild on me. Why is the neighbor calling my mom one time about I'm messing with him, and I've been over in the house?
The last decade has had
I don't even know why they mess with me like that.
Price changes around earnings over 10%. Basically saying it moves on average more than 10% one way or the other on earnings. Well, of the last 5 quarters, if you were to close right here, only one of those 5 quarters was
Oh my God, it's cold.
and it was an 11.6%
I'm trying to see it on.
move.
I'm right here though, y'all. I'm back.
You've now had 2 consecutive under 5%. It's just an afterthought. And I don't know if that's a good thing or a bad thing for this company. I don't know that just as an investor in it, that there's a lot from a business standpoint that is generating a tremendous amount of returns outside of when there's that excitement around a roaring kitty or volatility. And it just doesn't have that same volatility right now. So not a bad thing from a stability standpoint of the company. I think that they are far more stable than maybe they were, 3, 4, 5 years ago. But that stability almost works against the company. That the volatility is what made it interesting.
It is, and I think that's a really good point. That's also how I was looking at things here. The short interest has also come down, which would tell you, as yes, a sign of a more mature company, because you don't want your stock to ever be, seen as a short target or like short squeeze play. But it did also add an interesting element to trading activity that, yes, detached from fundamentals, without that, pretty major endorsement from the meme stock crowd. It's just, I agree, lackluster.
Yeah, well, I would say, I know what you mean by mature, but I almost use the word stable instead, because it's the instability, the questions, the people thinking, hey, this isn't worth anything, the business model is struggling, how much cash do they have? Those questions generated the opportunity for it to be a meme stock. Because all along, those who were, on the Reddit platform, on the Wall Street Bets forums, the Roaring Kitties, they believed in GameStop. They thought, hey, this is, a company that is stable and has potential, and it's being underappreciated, and that generated the excitement. It was like there's these short, positions that are off sides, and we're going to basically lean on them and force them to cover. It's going to generate this excitement. Well, if everyone's kind of like, there's not a lot of growth, but the company is stable, it doesn't have that kind of kindling for excitement anymore.
I completely agree. That is, I think, a great way to frame it. It's just like the lack of. Right now, there's a lot of, areas of the market that see this sort of hype cycle, but it just isn't really coming into some of these meme stock players like the way we were used to back in 2021. AMC, we haven't looked at it in quite some time, despite still unsure, having a very loyal.
Safe to say GameStop better performer than AMC at time, yeah.
Safe to say that different. I would say that I tie them together because they're both so heavily correlated with the industry.
Yeah, GameStop 1.0, 2.0 even.
Yes, but very, very much different business models, different, even guidance going forward into this year. But also, our next name is Cracker Barrel, was at one point almost trading like new stock characteristics, because we saw that huge backlash in regards to them changing their logo. We saw, the stock posting a pretty substantial loss earlier today, but then actually recovering some of the weakness on the sessions. So it's actually been a really interesting day of trading just in today's session for Cracker Barrel. Now, what has been a bigger miss for them was the fact that they basically turned on a lot of their shareholders and a lot of the values that established this company. And then, straight away from that old timer logo, they then went back to, of course, the old logo to make their shareholders and really just, customers happy. But they did highlight that the results were below their expectations as they had unique and ongoing headwinds, saying that they have now adjusted their operational initiatives and as well as their marketing to ensure that they are delivering more delicious food and exceptional experiences, as well as hopefully boosting their financial performance. So we saw, they reported some disappointment as far as their fiscal first quarter. Same-store sales were also disappointing, as well as a loss for this quarter, and trimmed their outlook, which initially, again, set shares lower. Now somehow we are able to recover this, though, with a 6.5% move to the upside.
Yeah, this is a tough one, because from a just business management standpoint, Cracker Barrel kind of broke the rule number one, which is deliver a product or service that your customers want. And I get that they maybe pulled in some consultants who had ideas about how they could grow and expand, but it's like there's always that risk of alienating what makes you what you are. And I've got no opinion. Cracker Barrel I'm not probably the target demo for Cracker Barrel. We live in an urban city. I don't even know where the closest one would be. Certainly know what it is, and that's not to say that I like or don't like the restaurant. But if you lose what you are and you alienate your customers and you break that trust, you're never guaranteed to get that back. And so you either make the pivot, expand in a new demo, or you try to get back what you had before that you were already trying to improve on. So tough look for the management team there, but stabilizing things, I guess. But performance, I think, says all you need to know. I know they're up, less than 1% today. That's a win, I guess. But time doesn't do this chart favors. The more you start adding on, it doesn't get better.
It is unfortunate that, like the financials, well, I do think necessary to perhaps attribute it to some of their mishaps during the quarter. It sort of revisited this narrative. I mean, like, we had put this to rest. We had put the story, at least as far as we were concerned, put it into bed. We talked about it for several days of the ongoing saga, like Trump was getting involved, all the backlash on social media. This was put to bed, and unfortunately, earnings kind of like reopened the wound of the massive, upset that they gave shareholders. Like company structure, they had actually shareholder votes to keep their CEO in spite of some of these headwinds. So perhaps that's hang on here. Hopefully a new narrative can rewrite itself, though, a more positive one in now the current quarter.
Yeah, and the last thing I want to say on this, though, it's not like this was a company that was like really performing nicely before they implemented some of these changes. So objective, if you're being objective, and I'm trying to play the other side too, I get why they asked some questions and thought changes might be useful or necessary, but there's always risk in change, and I think they ended up in a potentially worse situation trying to improve. So maybe you tip your cap for them trying to do something, but it's also like, wow, you really messed that up.
I know, so to your point, this was part of their turnaround strategy. This wasn't because they were just like, crushing it and wanted to revamp our logo. They were trying to really find new offerings to resonate with the younger consumer. So,
yeah, sort of like, are we having this slow goodbye? Is time moving past us? Are we losing slowly over time, eroding almost? And what can we do to pivot off that? But it's like, do we just speed it up, though?
I think that's the risk you make when you try to rebrand it. It does not go as well as you would have hoped. But last thing today to completely pivot here, Marvell, which is having an interesting week as they did launch their Golden Cable Initiative, which is a program that is aimed to accelerate their overall active electrical cable development at hyperscalers and at various AI infrastructure levels. So they do say this effort does provide validated designs as well as more advanced firmware and engineering support to help their partners bring high-performance AECs to market faster. They did also say their open architecture allows their partners to scale production and customize various features across leading platforms. But Marvell shares have seen this renewed pressure, especially as we've seen analyst downgrades this week, also saying that they likely lost Amazon's Trainium 3 and Trainium 4 chip designs to AI chip, citing this increased competitive pressure. And also, we've seen, analysts make commentary that they've seen slowed growth, that right now they're not necessarily the winning contract player that they were, years or months ago. So Marvell's now down about 18.5% on the year, but I will say, actually, making a pretty decent move today, we're up about 2.5%.
Yeah, with this company, we're a little bit time here.
Yeah, boy, I added to my neighbor, boy. You better call I'm out here talking to the police. I said, boy, you ever call my mama, boy? That's like I know you or somebody even talk like I don't even talk to him. Like,
it seems like there's some questions on
talking about my business. That was funny as hell. I had to tell the daddy. I said, tell your son to quit talking to my mama, boy. My mama already stressed out and stuff. And she ain't,
We'll be there for the top of our show today, though. Coming up next time,
I'm the genius over here.
Corey as well as Rigetti Computing, as both names are seeing some weakness today and some overall just contraction here, but both have been actually crushing it on a year-to-date basis.
I've been looking at the Q's forever on her. My bad, y'all. Alright, so yeah, Meta is just going down forever now because Meta cut their spending.
And stream live coverage wherever you are.
Everything was just running up crazy. But they just reached the high and now they about to pull back a little bit.
Actually, I see something from Schwab.
Yeah,
complex or invest and trade on your own.
And if you want, they can even
Man, look what they did to some of these stocks today, boy.
Taxes, insurance, and
It's
estate
coming
planning,
down
all
forever
with
and stuff.
We're experiencing technical difficulties. Carl.
Man, I had to get into a put or something.
Whether you're a bull or a bear, you'll want to catch the latest market action on Morning Movers with me, Diane King Hall, live from the floor of the New York Stock Exchange, only on Schwab Network.
Welcome back to Next Gen
Did break
Investing.
out, but here we go.
Dive into the charts with our chart master himself, Rick Ducat, and we're discussing two names in the generative AI world. Two different but similar names. They oftentimes trade in not close correlation, but they can see some similarities as far as like weakness. Like today, both names are pretty substantially lower, but CoreWeave is where we'll start. Obviously don't have the same historical data as it's a relative newcomer to the markets, but walk us through the latest here, Rick, from a technical standpoint, because both names are definitely volatile.
Right, so this one we had our high point come in at this area near 187. That was our all-time high in our shortened trading period here. But from there you could draw a trend line connecting
PL.
here on our chart.
The market going down, PL doing this thing, bro.
And then put it along these low points here. That could give you an idea of where you might see some potential support here. Certainly doesn't always pan out that way. Just one idea you can use in your toolbox here of technical analysis. So we can also see a couple of other points of interest here. For starters, this area, 85 or so, 85.26, that's where we saw a series of low points here. That was most recently where we struggled to get above once again as well. Now it's looking like we're holding on back above that area. So a bit of an encouraging development for the bullish crowd here. We can also see our recent lows, 64.62. If you were to backtrack once again, line up fairly closely with that old notable high point that we saw there. So an old...
I'm looking for a bounce somewhere in the market, and it go higher. It might wait till Jerome Powell come out though. It might do it at 2 o'clock.
The area to watch as well. For right now,
it might do it tomorrow.
Closely with that 85.
Just gotta see what's going on. Trade what you see.
So now, if we were to take a look at some of our moving averages here, as we do have a shortened time frame that we can look at here, these are simple moving averages. We have our 20-day and our 50-day simple moving averages here. We are above 20-day in this case here, which comes in at about 78.51. So that could be another area to be on the lookout for. Our 50-day comes in about 108.50, pretty close to our red line there that represented further support and resistance. So now we can see as well, we are out of the oversold area according to the RSI, which is our momentum indicator here. However, we still haven't really managed to make a big push above the 50 midline that separates bullish from bearish momentum. Even worse though too, we kind of have a longer term downward sloping trend line on the RSI. You can see starting all the way back there, trending lower, a series of progressively lower highs. That's not exactly what you'd want to see here, so the bulls would want to see that trend line broken and for price to make a push above some further resistance. So now, if we were to look at our volume profile study, it's a bit more messy here. Sometimes there's very clear, distinct nodes. In this case, there are some clear nodes, but they're quite close together. So one area to be on the lookout for right here, near about 74 or so, 74, 75, that is the area to the downside where the bulls would hope to find a foothold. We also have this area here near 91.50 or so. That lines up with the current price activity area here. And finally to the upside, around 105, that's a further area of potential resistance.
Okay, yeah, and a lot too, I think, definitely look out when we discuss, of course, the chart of CoreWeave, which is down now about 3.5% on the session. And now, as we do look to trade this name for example purposes, Alex, walk us through your thinking.
Yeah, we're getting towards that time of the year where we're looking at some options expirations out into the middle of January. So that's what we're doing here. January monthly cycle, that's the 16th of January 2026. 70-65 put vertical, so it's a neutral to bullish strategy. It's a volatile stock, so utilizing some of that higher implied volatility to get quite a ways out of the money. all relative though, of course. Now, with that, it's only $1 credit, so you risk 400 with only a chance to make 100, but your break-even's down at 69, so you're giving yourself some cushion, looking for this stock to kind of stabilize and maybe even work sideways to higher over time, over this next month or so for this one. So with that, risk 400, 4 to 1 risk reward, 69 to break even, looking for stability. That's going to be the theme of all the example trades we talked about today.
Okay, so now to shift gears into a similar world, of course, different chart though, and that's Rigetti Computing, which has been, pulling back substantially. It's amazing though that we're still actually, pretty higher on a year-to-date basis.
Yeah, 58.15, 14 to 58.15 is quite a rally there. But there is one thing I would want to point out in this chart here. It's a situation that's described as what's called a bull trap here. So when you have this extraordinary type of rally here that took us up to these very lofty prices here, oftentimes there will be a pullback to a prior area of resistance. In this case, we can see these old highs right here near 34. That's about where we bottomed out here. And then our next rally came substantially below the old highs here. So that's when the enthusiasm is perhaps starting to wane. This is a pattern to be on the lookout for as a sign of a potential further decline. It did play out to the downside in this case. Certainly not a guarantee. There's never any guarantees or sure things with this type of trading field here, but this is a thing that people, it's common enough that you would be on the lookout for it if you were worried about maybe the enthusiasm starting to dry up a bit for a name like this. So we can also look back and see the 20 level. That was where we had our best close, our dark green line. We also had this area of highs that we saw after our gap down. That was the low point that we had in our range, as well as a further high point there. So 14 to 20 was a supportive zone here.
Let's go.
Too close to touching that $20 mark most recently here. So now if we were to think about our moving averages, yellow 21 day and orange 63 day, right about here near 28, that's lining up with our old lows here and here that we saw. So this could be a confluence to watch out for to the upside here, push above that level, could open the door to that 34 mark once again. In this case, we do have the RSI breaking through its shorter term downward sloping trend line here, but also failing to overtake that 50 midline with any kind of a convincing push. So even though we are still trending up higher, we have given up our resistance area in terms of our price activity, and RSI is starting to falter somewhat. So now if we were to think about our volume profile and our volume activity, right here, this area right here near 25, that's a pretty small node here, but that's the standout price area that's closest to where we are right now. So that would be a notable point to hold here. If we were to move lower, volume starts to pick up again in this area here near about 17 or so, with our point of control coming in near 12. To the upside, not really a lot of clear volume activity to make sense of here. But our teal line here, our linear regression line, our line of best fit based on our closing prices, that comes in at about 30.50. That could be another area of potential resistance.
Okay, yeah, and a name that's also down about 5.5%, so a bit more of a steep selling day for Rigetti Computing, but, obviously a volatile player, and you tend to see some of these moves in either direction.
What are you trying to do to my Rigetti,
and
boy?
appreciate it too, Rick, our chart master, but last but not least, as we do think through now trading this name for example purposes, Alex, walk us through the thinking.
Yeah, a lot of cut and paste of the same thoughts, right? Volatile name, higher implied volatility, certainly come off the highs, neutral to bullish strategy, giving a little bit of cushion going out to that same January monthly cycle past the new year. Looking at it here, this was the 23.21 short put vertical, so smaller per share price, Jenny, smaller strategy with only a $2 wide example here. If you collect 50 cents on that, it creates a 3 to 1 risk reward, so a little bit of an improvement there. Risk 150, chance to make $50. Break even would be $22.50. Simply take that 50 cents away from that short 23 put as a part of that vertical. So same risk profile, neutral bullish, looking for stability, or at least if there's going to be movement, have that movement be to the upside.
Yeah, so one that, obviously capitalizes from some improved price activity, but we'll leave it there for Chartmaster today. Coming up next now, it's time to discuss the big move we're seeing to the upside today in GE Vernova, as we did see see the company raising now its forward-looking guidance and giving the street a lot of optimism, a lot of analyst praise for this name
GE, yeah. GE.
Trading at Schwab is powered by Ameritrade, unlocking the power of Thinkorswim, the award-winning trading platforms. Bring your trades into focus on Thinkorswim Desktop with robust charting and analysis tools, including over 400 technical studies. Tailor the platforms to your unique needs with nearly endless customization, and track market trends with up-to-the-minute news and insights. Trade brilliantly with Schwab.
Hey, Dad. I have a question for you.
Sure.
When did Granddad first start investing?
Granddad had an account with Schwab before there were branches in the area. He really started with nothing. He worked hard, and after he passed away, the torch has been passed to me, and my advisor, Jennifer, she was with me with the journey, helping with the estate distribution. The 2 grandchildren, planning for their college educations. Someday it'll be their turn.
What's up, Coral Nation? It's your #1 broker with the best full-service wealth management skills in the biz.
Actually, I'm seeing something from Schwab.
Uh-oh. Yeah, Schwab lets you invest and trade on your own.
And if you want, they can even manage it for you.
Not to mention, Schwab has a team of specialists for taxes, insurance, and estate planning, all with low fees.
We're experiencing technical difficulties. Carl.
Schwab, a modern approach to wealth management.
Welcome back to Next Gen Investing. Now we're joined by Marley Caden, of course, host for the Schwab Network, to dive into our FOMO name today, which is a no-brainer, GE Vernova. I mean, a pretty monster move today. I was saying earlier, pre-market, we were looking to make new highs. We easily surpassed that level, and I mean, a lot of enthusiasm coming from the sell side today. So Marley, walk us through all the good news for GE Vernova.
You said a lot of enthusiasm from the street, from the sell side analysts. We're seeing a move now up about 14.5%. It just keeps growing each time I look at GE Vernova. Shares are surging after the company doubled its dividend. They increased the scope for their share buybacks, and they raised their earnings projections all in an investor day, and they are being well rewarded today in terms of their stock price. They're now estimating their future earnings beyond 2028 to be $52 billion. That's up from $45 billion. They also raised their adjusted EBITDA margin for the same period to 20%, up from 14%. Now, GE Vernova was already one of the best performers in the S&P 500 this year, but they've now raised their per share quarterly dividend to 50 cents, and they've increased their share repurchase authorization to $10 billion, up from $6 billion. The company said it expects to grow its total backlog from $135 billion to about $200 billion by the end of 2028, which will include a doubling of its electrification segment backlog. That will be $60 billion, up from $30 billion. They also expect stronger than expected profit margins in both their power and electrification businesses. They did note, though, they do expect slightly weaker performance from their wind segment, but that is much smaller. EBITDA margins there are just yielding about 6%, whereas for the other two, they're expected to be about 22% for 2028. So really impressive growth numbers there from this investor day. Seemingly very happy with the outcome with some of the announcements, and as Jenny hinted at, we did get a lot of bullish commentary here, a lot of upgrades, a lot of price target hikes. Let's walk through a couple of them. At BMO Capital, up to 780 from 710. Right now we're trading at 713. They have their outperform rating they already had. They, of course, cited this 2028 EBITDA outlook. They also think that the guidance that they gave is conservative. They made that note. They said it was clearly conservative. They actually think it will be better than what they're putting out, and everybody was already impressed with those numbers. RBC Capital upgrades them to outperform. Price target of $761, up from $630. Now, this one's very important because they had a downgrade on GE Vernova prior to this, and they said they underappreciated the growth and margin opportunity that's showing no signs of slowing, driving margin expansion from the benefit of expanding equipment margins and productivity improvements. We also saw JP Morgan move their target up to $1,000, up from $740. So again, trading at $713 right now, keeping their overweight rating. Oppenheimer also upgrading them to outperform from perform with an $855 price target. Again, citing this guidance for 2028. We got B of A upping their target to $804, and UBS coming out saying that these new targets are very bullish. So positive sentiment pretty much across the board when it comes to these announcements.
Yeah, and I've seen nothing, but I mean, like the thinking this is basically just creating a new floor that we, I mean, could see further upside to definitely a ceiling that is well even beyond some of these targets. So I see nothing but really like praise for this company, just based on the fact that historically they've been pretty conservative. So you could understand, I mean, the enthusiasm tied to GE Vernova. It has a huge role in the build necessary for AI infrastructure. So a lot to be excited about there. Now, Alex, as we do think through trading this name, we're obviously in a really nice run. I mean, we're up now 116% on a year-to-date basis. I mean, made new highs today. We've risen 83%, off of lows made in April.
Well, and I was going to say, at the very top of the show, guys, we said, hey, the Fed's going to do a lot to determine how this day goes. I'm not sure it's going to have much say in how GEV's day went. I mean, this has been an incredible price performance today. But same strategy, neutral to bullish, short put vertical, but accelerating that timeline just a little bit. Reason being, the weekly options had $5 wide strike availability, where the monthly cycles were locked at 10. So to make this a little bit smaller trade, go into that January 2nd, 2026 cycle, so sort of representing the end of the year. If you believe this stock will maintain its price performance and stay above, let's say 650, which is where our short strike is, 650, 645 through the end of the year, and so you could collect somewhere around $1.25 for that strategy. You'd risk $375 with a chance to make 125, 648.75 would be the break even. Now, liquidity in these options, given the big underlying stock price and the kind of lack of activity in that January 2nd cycle, is something of note. But perhaps this is just an idea, an example, illustrating sort of the thought process for that using these prices.
Yeah, and I think that's, I mean, only continuing to rip here. We're up now 14%. So appreciate it to Marley Caden for that breakdown on GE Vernova, a name that is a clear winner of the session in spite of all the, macro turbulence we're expecting from the Fed. But coming up next, we'll discuss more of a Fed-focused theme, and that's the labor market, and perhaps some of the expected impact we could see with AI looming on the overall U.S. job market.
BMNU, ETHU, MIGO, ENBP. WRBY, EHOW, XLLN, BMNG. BMNJKU halted, BMNR, MRAL, MIGO, CHOW. SOLT, WRBY.
Believe me, when it comes to investing, you'll love Carl's Way. Take a left here, please.
But there's a...
Carl's Way is the best way.
Is it? At Schwab, how I choose to invest is up to me.
Exactly. I can invest and trade on my own.
Yes, and I let them manage some investments for me too.
Let's move on, shall we?
No can do.
I'll get out here.
Where are you going?
Schwab. Schwab, a modern approach to wealth management.
Stay connected to what moves markets. Download the Schwab Network app and stream live coverage wherever you are. Morning Movers brings traders the biggest headlines to start the day, from volatile overnight swings to the earliest analyst calls. Get your watch list ready. 8 a.m. Eastern. Morning Movers only on Schwab Network.
CHOW. ETHU.
Welcome back to Next Gen Investing. It's now time to discuss the latest from Palantir. Palantir is always a volatility generator. It's always worth diving into, especially on some news that they have secured now a $448 million deal with the U.S. Navy. Dan King Hall, the host of Morning Movers, is joining us now to break down the story. So Dan, walk us through the latest here on Palantir.
Yeah, this is welcome news for Palantir. Those shares moving higher off the back of this news of this $448 million deal with the U.S. Navy. And it's kind of, if you will, for Palantir returning to its bread and butter, because as we know, government contracts was where the company originally had the most momentum. And since then, it has started to see or seen over time more increases on the commercial side, but you can't ignore what's happening on the government side. Big deal for both sides of this. For the Navy, this is about modernizing and speeding up the process around shipbuilding. Shipbuilding is known to be slow, expensive, and often delayed because of slowness with parts arriving late or disappearing in paperwork. So Palantir's AI will replace thousands of hours of manual spreadsheet input. It'll track with real-time, all-in-one dashboard that is going to show where parts are, who needs them, and when failures are coming months ahead, not after a breakdown. So there was early proof of this. They did some pilot. Those pilots work. Submarine scheduling that usually used to take 160 hours now takes under 10 minutes with this AI. So they drop time from weeks and hours to minutes here. Part forecasting that usually apparently takes some 20,000 human hours is now also dropped down and predicted automatically. So the big picture is that this is not just about the submarines and ships. It could lay the groundwork for an even deeper relationship with the Navy and beyond that with its government contracts. So we're talking about aircraft carriers, destroyers, and even fighter jets, and just the process and increasing the speed at which this process occurs. Guys.
Diane, the news, the positive news just keeps rolling for this company, whether it's commercial deals, government contracts, international, domestic. My question to you is a little bit more bigger picture, though. I know you have an opportunity to talk to a lot of traders there, whether it's in passing or on your show, analysts as well, investors. It seems retail, if I use something like Schwab Stacks, this is consistently amongst the top buys into this narrative, buys into the belief in Palantir, whether it's Dr. Karp and the eccentric nature of him that's almost Elon Musk-like superstardom, or it's the next age, new next-gen technology that they work on that has captivated their attention. What about the professionals? Are they buying into this too, or are they skeptical because of the big price tag?
The analysts that I talk to, hear from, read, their commentaries is more on the skeptical because of the skeptical side because of just the valuation. They can't ignore the move that's occurred this year in this, because even with some of the bumpiness that had happened recently, it's still a huge outperformer year to date. But again, the valuation of it, the price tag seems to be a little too rich for when the analysts look at it. But again,
let me see Palantir.
Really like this
Palantir
market.
was doing good
At the
today.
beginning of the year, they did well.
But
But you're right. I've seen Alex Karp here, and it's funny. He actually seems understated, but at the same time, you've seen him in interviews. You hear him on earnings calls, and it's bombastic, kind of, or even the eccentric quirks that he seems to have, and investors, especially from the retail side, seem to really like that. And look, the company has strength in both government and commercial contracts, but again, that price tag is where analysts have questions.
Yeah, and I think that's a really interesting sort of summation of Alex Karp. He's so, to me, like, infamous. He's almost like a celebrity. I mean, in our world, he definitely is a celebrity. So I think at a really interesting point about how he's somewhat understated, but some of his commentary, I mean, is hugely why there's so much upside. Really, I'd say definitely driving some of the overall price performance of Palantir. I feel like every single day we're looking at things on a pretty bright spot. But so appreciate that, Dan King Hall, for the breakdown on the news today around Palantir. Now, I'd like to welcome in Harley Lipman, CEO and founder of Genesis 10, for a really timely conversation. Harley, thanks so much for being here. I mean, let's start with your real expectations for the overall labor force as we head into 2026.
Well, it's going to be a tough labor market, especially for entry-level jobs. Very few people are quitting their jobs these days. It's at a 5-year low, the percentage of people who are voluntarily leaving their employers. So it's going to be tight, but the job market will embrace people who embrace AI. They don't want employees who are uncomfortable or who are intimidated by AI. And remember, AI is not coming after your job. What they're doing is they're coming after the 30% of the work that you do that's repetitive. That's what they're coming after.
Harley, I'm sure you're familiar
Okay,
with
okay.
the concept
They're not
of the
coming for our
beverage
jobs,
curve. For our
okay.
viewers who maybe aren't, it's basically that if you chart job openings and you chart, where that intersects with unemployment, they kind of have an inverse relationship oftentimes. We've certainly seen job openings come down. Are we at a worrisome point where that's reflective of perhaps an increase in unemployment sooner rather than later in your mind?
Not really. I mean, slightly unemployment will increase, but that's normal. There's going to be no mass layoffs if things stay the same. It's simply that companies are adjusting to the AI revolution, and they would be wise to keep their entry-level employees and retrain them, reskill them. The companies that reskill their employees are going to be the winners. The companies that just go to slash and burn and lay off people, they will lose in the midterm and long term because they're going to lose institutional knowledge. And they're going to lose future leaders. That's why you need entry-level people.
Right, right.
The idea of AI is to boost productivity of your existing workers. So you don't want to replace them. You don't have the robots to do the work, at least not yet. So you need to reskill and retrain your people. So what they can do is take AI to the next level in terms of output and productivity.
So do you think that we could face a real shortage of talent when looking at, say, beyond the entry-level jobs? I mean, more of like the mid to senior level where you're lacking some of these necessary skills that, frankly, you learn as an entry-level employee with, of course, the introduction of AI, which is a wonderful tool, yes, but it does remove a bit of the foundations that are required to truly learn to do a job.
Well, companies have to reskill. And even people could help themselves by taking courses online. No one knows a lot about AI at this point. It's so new. So what gets in the way is people get intimidated. They go, oh my God, AI, what is it? And so they tend to be reluctant to learn it. But if you just get the basics, you'll be where you need to be. And again, if you're working for a bigger company, the smarter companies are going to do what we do. We have something called Dev 10 where we train people and reskill them. And we have found that makes the world of difference because clients do need to keep their employees. They just need them to focus on more human-oriented areas such as critical thinking, problem solving, innovation, collaboration, empathy. That AI cannot replace. So for those people who have good, EQ as it called, emotional intelligence, for people with good communication skills, can communicate well with customers, those positions are solid. And companies are going to need more people like that. So if you're a leader and you're an innovator, you're a problem solver, you're a critical thinker, AI is going to give you tools
Let's
to
go.
do a job. Your job will not be threatened.
Yeah.
It'll be all about, like anything, the ROI, what you bring to the table. But AI tools will help you be more productive.
Yeah, let's go. Yeah, I keep telling them that. Yeah,
In that final answer, it sounds like thinking skills, visionary, kind of seeing the chessboard more than being a piece on the board is the skill set that's going to be valued. Where does that burden fall in terms of getting those skills? Is that the individual going out of their way to find these resources, or do colleges and high schools need to retool their curriculum to meet the modern world?
Well, your last sentence says it all. I think high schools, colleges, employers, and above all people, chart your own destiny. Again, you could be a navigator, you could be a survivor, or you could be a victim. You want to be a navigator. And a navigator means get online, learn a little bit about AI, talk to your employer about them training you. They'll like that you want to embrace AI. Again, companies want people who are willing to embrace the future, and that's what AI represents. So I think you'll see more of AI next year, but you'll be less alarmed, as I think people are going to use it to be innovators and good problem solvers.
Yeah, and adaptability element, I think, is just hugely important probably in general, but it's never really been more central right now to the overall labor force. So really appreciate it, and a great tie-in as we were discussing the labor force at length here with the Fed coming up. Harley Lipman, CEO and founder of Genesis 10. But now to welcome in George Chill, senior markets correspondent for the network, to give us more insights on the, of course, looming decision from the FOMC in about 10 minutes or so. So George, what are your thoughts here on the Fed today?
Well, I wouldn't go, make trades based on, the reaction right after, because the volatility that happens post-Fed decisions is quite robust, and the move can just go counteractive against what you believe the Fed move should be. So, just be nimble in terms of what the expectations are from the market after. Obviously, they're going to be cutting rates by 25 basis points, essentially now to between 3.5 and 3.75. If you look at the SEP, the Summer Economic Projections, going back to September, they're going to have a whole new data collection, including the dot plot this come around, because every other meeting they have the SEP. They basically told us that their objective target this year is 3.6%. So I think the important factors that a lot of folks will be looking for will include projections on GDP, the labor market, core PCE, which right now, based on September numbers, is still around 3.1%. And even if that number stays where it's at into 2026, or through the remainder of the year, they're still restricted. Let's put it that way, even at essentially around 3.6% if they move the target down to that level today. I think the other thing is there's going to be a lot of language, maybe some questions about balance sheet. If you look at the balance sheet of the Fed, essentially they're looking at not increasing or decreasing anymore. They're mitigating quantitative tightening. They told us this not too long ago. Right now, around $6.5 trillion versus about $9 trillion going back to late 2022. But I do think that there'll be some questions about the balance sheet strategy, and also there may be some questions about Jerome Powell and the FOMC's take on the tariffs, because the tariffs itself have been really impacting bank reserves. If you look at bank reserves compared to late 2021, they were around 4.1 trillion. Now, just based on the last month's print from the Fred database, it's around 2.9.
George, I'm sure you caught at least a little bit of our last conversation, but I just wanted you to know that you're for sure irreplaceable by AI. My question to you, though, Mr. Tillis, the last 4 Federal Reserve meetings, the price reaction has been like 0.1% or less. So if you were told that the move was outsized versus expectations or closer to unchanged, what would be more surprising to you and why?
I would be surprised by the outsized move initially, because there can be a delayed reaction, and I think this is important. So right when they announce the numbers, there'll be probably a tight move, but I suggest there may be a little bit more of a delayed outside move, and that could manifest, in the next day. It could manifest near the close, or tomorrow, or even through Friday, or even through next week. So just be mindful of that. And right now, the markets, for lack of a better word, really haven't done much since October. We've been in a tight trading range. We may still be in a trading range still, but from a trend standpoint, we have to either break higher or break lower. And I'll be looking for that for positioning, at least going into the mid part of December. We're almost there. To the point where maybe the market pulls back a little bit. If this is more of a hawkish cut, this is some of the concerns about Jerome Powell saying, hey, we're going to wait and see. And if you look at the projections for next year, there's only one projection for another cut. So the market is already pricing in a wait and see situation for next year. But nonetheless, again, if they expect much weaker unemployment numbers, that will actually be a bad thing. But if they expect lower inflation numbers, that will actually be a good thing. So, a lot of moving parts here, but, caution. That's just how I approach it. Every Fed day is very, very difficult to trade. That's my viewpoint.
Yeah, I could not agree more. And so I think caution is good for, say, the next, 45 to an hour, as far as trading is concerned. But appreciate it, George Tillis, for all of that breakdown as we do approach the Fed announcement here. We're about 5 minutes away. But really quickly before we go, Alex, we have dipped a bit in the overall markets. But to your point, it doesn't really matter once we get finally some numbers, some clarity, and of course here's some commentary from Jerome Powell. We have really like the main course of today's trading activity coming in the next 30 or so minutes.
Look, everybody's situation is different, so there's never a one-size-fits-all answer, but liquidity really dries up in these next few minutes, so hopefully you've done what you need to do to be prepared for this. Things are going to move around quite a bit over the next couple hours, and there's a reason we got these circled on the calendar. They're fun because there's a lot that we're about to learn.
There's a lot that we are about to learn. Of course, we still also have Oracle earnings after the close today, so a lot to go through over the next several hours. But appreciate you for tuning in to Next Gen Investing. We have the watch list, and of course, a very Fed special watch list coming up next.
Whether you're an experienced investor or just getting started, Charles Schwab offers a webcast that's right for you. The Platforms and Tools webcasts are designed to help you broaden your knowledge of platform features and resources available from Schwab. You'll learn tips and tricks to help navigate Schwab.com, Thinkorswim, and mobile-based platforms. Best of all, you can ask questions by chatting directly with an education coach. It's interactive learning at its finest. Tune in live or watch on demand. Head over to schwab.com/coaching and start learning today.
LDW1.
Welcome to Schwab Network, where real-time market coverage is expert strategy. From the opening bell to the closing bell, we've got you covered. Get inside the minds of pro traders.
My point is that they're getting a higher rate of change in sales based on their guidance, not the same rate of change on EPS.
Follow the biggest headlines, live analysis, breaking news, and sharp trade ideas, minute by minute. The show's built for action. We break it all down in real time with speed, accuracy, and precision.
I think one of the most important things is you're making a play in a risk-defined way you're going into earnings.
So that would be a further downside area to watch.
Smart insights, actionable data, better for traders, and trusted financial journalists. Streaming live and on demand. Schwab Network, streaming 24/7, any screen, anywhere, free. SchwabNetwork.com. 2025 kept investors on their toes. Now, get ready for the road ahead. Join Schwab's panel of experts on December 11th for 2026 Market Outlook, your guide to the forces shaping stocks, global markets, inflation, rates, and more. Hear from experts on where the markets may be headed, spot opportunities, and see what could drive your portfolio next year. Tune in on December 11th at 7 p.m. Eastern on Schwab Network.
I'm Nicole Pedalides at the New York Stock Exchange. Live interviews, market movers, and real-time coverage right from the floor. Subscribe now at schwabnetwork.com.
Full service publishing. Book production, writing coach, manuscript development, promotion, and distribution. Get it in by the benefit of our books are printed in the USA. Manuscripts wanted. Get in touch with us for a free guide. All our consultants are located in the U.S. For over 100 years, we've been fulfilling dreams of becoming a publisher. Become a published author with us. Stories, book publishing, and promotion. Get your book published. So if you want to try to profitably, the best place to start, probably just go to this free community. Yeah, literally it's free. So I'm in there now. Now a bunch of like so all of these guys are six-figure traders, right? This guy, six-figure trader.
Good afternoon. Welcome to the Watch List. I'm Nicole Pedalides. It's 2 p.m. Eastern Time. We're coming to you live on the floor of the New York Stock Exchange, where traders are very much anticipated Fed decision is imminent.
For example,
We're
this
starting to
guy
hear
here
the
has
hushes
large,
on the floor as
like
everybody is
shares
waiting. Right now,
with,
stocks have
just
been
trading
mixed
stuff
back
and
and
he,
forth
yeah,
throughout
and
this
he's more
day.
like
Will the
that.
Fed
So
cut
they're
for the
not
third
discussing
time
it.
in
But
a
if
row?
you're
You
serious
hear
about
people saying
actually wanting
shh
to
as they
have a
wait to
trade,
hear
get
this.
off.
It's anticipated 90% likelihood we'll get a 25 basis point cut, and then at 2:30 we'll hear from our Fed chair, Jay Powell, and that will be clear. Will this language be something more towards a hawkish cut? 25. So the traders are saying that they hear 25 basis points. We're waiting on the confirmation, but right now, so that's what the stock market anticipated was the 25 basis point. And we have confirmation, 25 basis point cut. We got exactly what we anticipated. Now it's going to be whether or not this is a hawkish cut. Is this the last time Jay Powell will make a cut and as the Fed chair before the new one is instituted in the new year? Here's a look at the markets right now. Where do we stand? You see the S&P 500 up a quarter of 1% at 6853 right now. And you see the NASDAQ is down 15 points. The Dow is up 304 points. So stocks are moving higher now intraday. The Russell's up 1/3 of 1%. And we're seeing gold also turn around. Gold is higher here. And oil, which was at 58.29, is also moving higher. So everything is moving higher. It's worth noting that 10-year bond yield, well, right now we're seeing that at 4.15, have been as high as 4.20 today. So also very interesting here. So that's what we're starting this off with. Kevin Hayes, host of Fast Market, joins me of Schwab Network, because we're going to be looking not only at stocks moving higher, but also we can't wait to hear, are there dissenters? You know, Stephen Myron's probably said 50 basis points, right? What else are we going to wait and see, right?
3 dissenters, Nicole. Austin Goolsbee also dissented for 0 cuts. So of the voters, Stephen Myron voted again, dissented for 50 basis point cut. Jeffrey Schmidt and Austin Goolsbee, no cut, which means Jerome Powell, John Williams, Michael Barr, Michelle Bowman, Susan Collins, Lisa Cook, Philip Jefferson, Alberto Mussolem, and Christopher Waller all voted for a 25 basis point cut. So then, getting into the economic, the summary of economic projections, we're getting that as it's coming. But right now, it's 3 dissenters. Remember, we thought there might be more. Remember, here's the thing: Beth Hammock and Lori Logan didn't vote, so they're not dissenters. But Austin Goolsbee was the addition to the dissenters, Nicole.
It'll be interesting to hear why. You know, the question is whether or not are they more worried about inflation. We know the labor picture has slowed. It's been evident. We've seen the evidence of that. But the question is, you know, are they making the wrong decision? And that's why Schmidt last time sort of, you know, broke out. The prior time they all got on board and made the same decision to prove a point against Stephen Myron. After that, Schmidt in the last meeting said, you know what, I really think it should be 0. And that's where the conversation started to really ramp up whether or not we would get another cut. You know, that's why, you know, is he more worried about inflation?
Yeah, exactly right. The big, remember, the dual mandate. If you are voting like Austin Goolsbee and Jeffrey Schmidt did for no cut, you think inflation is high and sticky, which you can make the case that it's not to target, but you can't make the case that it's sticky because it's slowly but surely coming lower. Now, if you voted to lower interest rates like the rest of the committee did, and Stephen Myron voted for 50 basis points, you think the labor market is the bigger concern. And that is the number. Remember, the last unemployment rate that we got was 4.44%, which was one tick away from being rounded to 4.5%. So if you're working, you know, the people, the majority of the members, remember, 12 voters, so 3 dissenters, which means 9 people voted for a 25 basis point cut. One Go ahead.
I wanted to jump in here and talk about the fact that now we're looking at the fact they're going to be, the Fed says it will buy $40 billion of Treasury bills in the next 30 days. Now, you know that they had, there it is. So, I know, that's why I interrupted you, because I knew you would find that important. You know, last time when we we heard that, right, QT was stopping, it was essentially QE, and the question then became, when will the Fed start to buy the T-bills? And the Fed had been, they stopped shrinking the balance sheet on December 1st, but now this next move here is a move for a larger growing balance sheet. So 40 billion, it says. Your thoughts?
Exactly right. Remember, the big question was, when we ended QT on December 1st, would we start to do QE and start to add to the balance sheet and buy treasuries? $40 billion says yes, they're starting to buy treasuries. The overall market, the housing market, interest rates should all move favorably because of that. Let's see if it fuels a stock market rally. The E-minis were pretty much unchanged when it started. They're now up, about 10 points. So they're rallying. Watch the 10-year yield. Got 4.17 and hasn't moved very much since the number came out, but we'll watch how that filters into the system over the coming weeks, Nicole. Yes, QE is back.
All right, so 4 officials penciled in 2 quarter-point cuts for 2026. A lot of folks had anticipated that we would only see 2 in 2026. We're looking at dot plots. Also, the median GDP projection, 1.7% in 2025, 2.3% in 2026. Median unemployment projection, 4.5% in 25, 4.4%. So it's coming down in 2026. So that shows unemployment coming in the right direction. At the same time, they talked about the economic activity and that expanding. Okay, so this is screaming no cut right now. I mean, you're not going to see any cut in the next meeting, right? Because it says available indicators suggest that the economic activity has been expanding at a moderate pace. So it's sort of like even though job gains have slowed, the indicators are showing the developments that people are out and the economic activity is expanding. In fact, we're going from 1.7% GDP projection to 2.3%. Your thoughts?
Yeah, I'm looking at the S&P as well. It's got GDP going down a tick. It's got the unemployment rate staying, but it's staying where? 4.5%. It's got PCE going from 2.9 to 3% in the projections, and it's got the core PCE going up. So these S&P for September from September has it going down, has PCE going from 3 to 2.9, 4.5% unemployment. So they do have PCE and core PCE coming down ever so slightly from the September numbers, but like I said, this is all these numbers, everything we're digesting. This is a snapshot of what we're seeing right now from the projections, but it's fascinating how much data we're getting and working through right now, Nicole.
I'm surprised the market's not selling off, because this could almost mean no rate cuts coming. We have to wait and see, and I know they're data dependent. We're getting a jobs report, delayed jobs report on December 16th. We did not get it on the first Friday of the month like we usually did because of the government shutdown. So I guess they're waiting on more data, but I would anticipate that some folks might even look at this and say they don't really see any rate cuts anytime soon. It got pushed back from March to more likely in April, right? So we'll watch for all of that. Great to see you. Kevin Hanks, thank you so much. I turn my attention over to Jeffrey Cleveland, Director, Chief Economist at Payton & Regal. Some of your takeaways from what we're hearing from the Fed right now.
Yeah, actually, Nicole, I thought the interesting bit is in the very first paragraph of the FOMC statement. They did make a change acknowledging that the unemployment rate has edged up. Formerly, that little clause in the statement said that unemployment has remained low. So it's sort of acknowledging a little bit of change there. We see that in the unemployment rate drifting higher, so I think that's important. As Kevin said, I think the bit about expanding the Fed's balance sheet, opening the door to that, is important. I guess I would just a word of caution on the dots for next year. It will depend on what happens with the data. So as of now, it looks like policymakers think the unemployment rate will stay steady or even go a little bit lower. But if the unemployment rate continues to rise next year, there will be cutting rates. So,
They're anticipating, right?
Exactly.
They're saying that it's going to go from 4.5% to 4.4%.
That sounds like hope casting to me rather than forecasting.
Rose-colored glasses or something. The move here, they talk about the economy expanding at a moderate pace. Though job gains have slowed, they did talk about unemployment edged up through September, says uncertainty about economic outlook remains elevated.
Yeah, I think the risk here, Nicole, is that the unemployment rate edges a bit higher, and I think the core PCE rate comes in a bit lower than the median FOMC expectation next year. And if you have that combination, I do think the Fed funds rate will be lower than the median estimate at this point. So we'll just have to see how things go.
This is not the hawkish cut. I mean, I've already seen Fed cuts rates again, signals it may be done for now. I also saw one more headline to the tune of that. I anticipate that, I was saying to Kevin a moment ago, that in interpreting this, doesn't scream cut. It just doesn't. This could be the hawkish cut.
Yeah, I don't know. I mean, the market reaction in bonds so far, I don't think, I guess if we were seeing a hawkish cut, we would expect to see 10-year yields up, maybe 2-year yields up. So far, we're seeing the opposite of that. So the bond market reading maybe something different into it than that, Nicole. We'll have to see, though, how Chair Powell frames things. I think, as ever, like the press conference framing will be important, so maybe your hawkish cut will come back into play there. One other thing on the bond market, bond people, I'm a bond nerd, so bond people really focus on this longer-term dot, the so-called neutral dot, and there was some expectation, Nicole, that would creep up, and it did in the dots. It's still at 3%, so maybe that's something else that's making the bond market a little more optimistic.
Right, they're going to wait to see what he says in the 2:30 press conference, and the Q&A is really, the prepared statement's one thing, but then the Q&A is what everybody really hangs on. Anything in the language that you're watching for in particular?
Well, I think everyone wants to see what is the dispersion in the committee. What are the disagreements, as you mentioned? Is it overinflation? Is it because people are more optimistic on the labor market? What creates the dissent? I'm sure the dissenters actually will come out next week and tell us. Maybe they'll write a nice blog post or something detailing, or give a speech. So we'll find that out. But I think that would be interesting just to get a sense of the committee and how they're thinking. I think, though, from my perspective, what I worry about most, Nicole, is when everyone agrees. Like the groupthink is too extreme. I thought we had that in 2021, in 2022, when everyone said inflation was transitory. Turns out it wasn't. So I worry more about that, the groupthink. If there's a lot of different opinions, I don't know. I think that could be good for monetary policy. At least it will make things interesting for Fed watchers.
Well, the inflation outlook was coming down, so that may be a good thing, at least if you're looking for more cuts. But the stock market, when I look at the S&P 500 for an intraday, for example, it did move to session highs now after the release of this number. It moved to 68, 67, 72 on the S&P 500. But, as our old friend who has passed, and may rest in peace, Art Cashin here on the floor of UBS, he always used to say, stay nimble. And this is very fast-moving next half hour. At this point, but we did see, for example, that we did see those stocks moving higher and oil and gold move higher, and the 10-year bonds holding that 416 right now. Jeffrey Cleveland, it's great to see you. I'm so glad you were able to be with me, Jeffrey, on such an important day here. Director Chief Economist Payman Regal, thank you. Coming up next, we'll continue our coverage of today's Fed rate decision at 2:30 p.m. We'll go to Washington for our Fed Chair Jerome Powell's press conference.
Oh, yeah, give me a second. I'll be right back.
Live as well, and we'll continue to watch all these market moves. We'll be right back.